Votto's on. I see Santos on. I see Nick's on. Eswar's on. Is Drew Lanza on?
Not yet.
Howard Lee. I don't think I saw.
Not yet.
Okay. And Vince, I don't believe I've seen yet.
Not yet.
Okay.
Oh, Vince is on his way. Vince is on his way in.
Okay. We'll just wait a couple more minutes, see if we could grab Drew and Howard. Now there's Vince. All right, so we're still looking for Drew and Howard. Is that it?
Yes.
Okay.
Drew is on his way in.
All right, thank you. Hi, Drew. I see you on.
Yeah, sorry, I had to reboot my computer.
No problem. All right. And do we know if Howard Lee is going to be joining us today, by any chance?
Yes.
Yes. Okay. All right, we got 8 of the 9 trustees here. Let's go ahead and get started. It's 8:33, and Howard should be joining us shortly. So let's go ahead and let's bring this meeting to order. This is the Police and Fire Retirement Board meeting for Thursday, June 4th, 2020. Do a quick roll call. Andrew Gardner, myself, is present. Drew Lanza.
Yep, here, Andrew.
Howard Lee. All right, Howard Lee hasn't joined us yet, but he will be shortly. Eswar Menon.
Present.
Nick Muyo.
Yeah, I'm here.
Richard Santos.
Yes.
Vincent Cesari. I see.
Unmute Vince.
Yeah. He's having some auto difficulties, but we do see him speaking. So I'll count that as present. Franco Votto. Thanks, Vince. Franco Votto. Okay. And we do have one open spot right now. So then we also have our CEO, Roberto, on the line. I see our CIO, Prabhu Palani, present. And Harvey Lederman, our General and Fiduciary Counsel, is present. And then we got a lot of our staff member, investment staff, and regular staff on the line helping us out through this process. So thank you. So at this time, we are going to go ahead and go to closed session. We're going to do closed session a little bit different this time from the last time we had our meeting. We do not need to log off. Everybody that's invited to this closed session will be receiving a pop-up on your screen to take us to a side room.
Ooh, Linda's mastered side rooms. I haven't even mastered that yet, Linda. I gotta call you and learn from you.
Well, wait, just let's hope this works.
If I jinx it, I owe you a beer.
I'm opening up.
To open session, there is no reportable items coming out from closed session. We'll go ahead and jump to orders of the day. Just to remind everybody, just on some of the simple ground rules, there will be roll call votes on any item that needs to have action taken. If you're not speaking, please have everything on mute, which everybody's doing, so I appreciate it. In regards to debate, I'll just go do a roll call, go down the list for everybody that wants to participate and say anything. Other than that, we do have some items to wave sunshine on, and those are attachments that came in late for 2C, 2D, 2E, 2F, 2G, and 4I. Can I get a motion to wave sunshine?
So moved, Santos.
Motion by Santos, a second.
Motion by Santos, second.
Second by Censari.
Second by Censari. Any comments? All right. Drew Lanza.
Aye.
Howard Lee.
Yes.
Eswar Menon.
Aye.
Nick Muyo.
Aye.
Richard Santos.
Yes.
Vincent Seri. Vincent Seri.
Probably muted.
Yeah, it's probably muted. All right. Franco Avato.
Aye.
And myself, aye. Vince, you there?
No, he's muted.
Okay. All right. So since we were unable to hear Vince, we'll just go past 7-0 on that one. So thank you on the minutes, or thanks for the waving sunshine. Next item, consent calendar. Is there anything on the consent calendar you guys would like to pull for discussion? If not, I'll entertain a motion.
So moved, Santos.
Motion by Santos.
Second, Votto.
Second, Votto. Any comments, public comments? All right. Drew Lanza.
Aye.
Howard Lee.
Yes.
Eswar Menon.
Aye.
Nick Muyo.
Aye.
Rich Santos.
Yes.
Vincent Seri. No comment from Vince. Franco Votto.
Aye.
And myself, Gardner. Aye. So that passes. All right, we'll go down to item 2, investments. 2A, oral update from CIO Prabhu Palani.
Thank you, Mr. Chairman. We have a number of items under investments this morning. Hopefully we can go through them quickly. But before we get to, we'll start with the presentation by Neuberger Berman on performance for fourth quarter. But before we get to that, I do have the April flash reports in, and I'm just going to read out those numbers. In April, the plan returned 4.8% versus the plan's benchmark of 5.41. And the 3 months ending April, the plan returned a negative 5.37 versus benchmark of negative 5.26. And fiscal year to date, the plan returned a negative 0.46, so negative 46 basis points versus a benchmark of negative 15 basis points. So obviously from the March lows, the markets have come back strongly. And as of the end of April, fiscal year to date, we're almost back to zero, which is good news. and hopefully the strength in the markets will continue and lessen the pain for our sponsor as well as our beneficiaries. With that, Mr. Chairman, I would like to move on to other items unless there are any questions.
If anybody has any questions, go ahead and speak up. Otherwise, we'll just move on to the next item.
Yeah, if I may ask a question here.
Go ahead.
Chair.
Yep.
So Prabhu, so April end, so plus 4.8 for the month of April.
That's right.
Do you know how the peer group is performed in April? And my question is, so we did well on the downturn. We have reallocated, having more growth, risk, I guess. How are we doing with the new allocation?
No, we don't know what the peer group has done as yet.
Thank you. That's all.
Yeah, so as we're on the pure stuff, from my understanding, we only get those on a quarterly basis. So when Makita does present today quarterly, we'll see what peer's done, but that is through the end of March, so basically through the downturn. But we will not be able to see what we did in Q2 until August, September.
That's right. Yeah.
Thank you.
All right, if there's any other questions, if not, we'll move on to the next item.
Thank you, Mr. Chairman. So item 2B is presentation of fourth quarter private equity report by Neuberger, and I believe we have Casey Boyer online. Brian, do you want to take over?
Okay, perfect.
Go ahead, Keith.
Okay, thank you. This is Casey Boyer. I will continue unless making sure everyone can hear me. I think that is the case. So thank you for having me. We really do appreciate the opportunity to get in front of you all quarterly. And I also do appreciate the use of Zoom, so I can actually put some faces to names here, and you can do the same. So you have in front of yourself the Q4 report, and I'll cover page 2, Brian, if you turn to that page, just kind of the first summary page. This shows just a lot of the high-level metrics for both the Neuberger-Berman strategic partnership, which is the column right in the middle, as well as the legacy portfolio, which is all of the private equity investments that were made by police and fire prior to prior to the start of our strategic partnership. And then also a couple investments that have been made by your team post that time. But what you'll see here is high-level statistics. As a reminder, the strategic partnership with Neuberger-Berman was started just over 3 years ago now. And the primary goals of the partnership was really to build a customized global private equity portfolio utilizing primary fund investments, which is making a direct investment into a private equity firm, secondaries, which is the investing into a private equity fund as well, but on a secondary basis, and then co-investments, which is investing directly into a company alongside a sponsor or alongside a private equity GP. And that is how we have gone about building the business. Currently, police and fire have a little over 220 million of commitments that we have made into underlying investments. We have, as of Q4, we had a little bit over 40 million left to commit. Importantly, and very important for today's world, you'll see here a little over 80 million of capital has actually been contributed, or in other words, that capital has actually been invested. So when you look at the numbers, we still have, there's approximately 30% of invested capital at a net level, meaning we have a lot of capital left to deploy. And I view that as a very good thing going into the next few years. Hopefully, you know, the private equity markets historically after recessions have been a very good time to invest and to put capital to work. So the positioning of your portfolio right now, I think, is doing very well. The net returns are shown there at the bottom. So currently 14.6% net IRR and a 1.1 times multiple. More specifically, if you take that multiple out another decimal, it's 1.14 times at Q4. At Q3, those same numbers were 1.1 times and 13.6% net IRR. So trending positively. Obviously, the big question is how will everything perform in Q1? And I'll just give you a little background and update on what we expect to see for your portfolio. We've been doing an enormous amount of tracking and monitoring for all of our portfolios. And overall, we track about 200 buyout funds, and across the board, kind of what we expect average for those portfolios in Q1 to be down about 9%. However, within your portfolio specifically, we've received to date about 96% of Q1 marks, and it's currently down about 4.7%. So Q1, given kind of market and environment, will be down a little bit, but I think relative to kind of overall market, it should be still performing fairly well at this point. So I just wanted to give some high-level perspectives today. I'm happy to go through more of the presentation if needed, but I'll open it up for questions at this point.
All right, thank you, Casey. Drew Lonzo, do you have any questions, comments? We'll come back to Drew. Can't hear you. Trustee Lee.
One question, Casey. Thank you for the presentation. Just in terms of buyout funds, do you have a sense of where the market is going for the size of those funds and the returns for the year?
Yeah, so we did, we've kind of put together an overall analysis just from our findings, which I believe is a pretty good grasp on the market given kind of how much we're invested, and by size to large buyout, smaller buyout. And it looks like the small cap and mid cap buyout space, they're really anywhere from down 2% to down 14%. And then large cap buyout down anywhere from 5% to 16%. Large cap firms are down, seem to be down a little bit more than the smaller mid cap buyout space. And we tend to think that's not necessarily because of the companies specifically, but large cap buyout funds are much more reliant on third-party valuation providers and on public comparable valuations. So I think it has more to do kind of with outside factors rather than the company specifics. So we also anticipate moving forward Q2, Q3 large cap buyout firms may go up slightly since they have been written down just a little bit more. But those are kind of the ranges that we're seeing.
Great, thank you.
Mm-hmm.
Thanks, Howard. Trustee Menon.
Yeah, thank you for the presentation. So just quick question. If I look at the underlying commitments of 223.7 for the New Burger partnership, and then a contributor capital of 82.8, how much of those are in co-investments?
So we have approximately 30% allocation to co-investments and secondaries. We put co-investments and secondaries into a bucket because we view them opportunistically and like to keep a little bit of flexibility in there to assess the market. As you can tell, historically, you can tell we've invested into 22 co-investments and only 2 secondaries. That really does speak to the market. We've seen better opportunities in terms of a risk return perspective from co-investments recently. That may change going forward. But overall, our allocation is around 30%.
Okay, and does the market dislocation, I would think that, you know, there's definitely some impact on the private equity side. Does it give you more opportunities in terms of co-investment in the next, 6 to 9 months?
Yeah, I think it will. As you know, prices over the last few years have been high, but also companies have been performing very well. So and it's kind of interesting what we've seen recently, and this may change, but currently our deal flow has gone down just because, markets have kind of halted at some level, specifically, on the credit side. But the deal flow is starting to pick up again a little bit, which is quicker than we had anticipated. If we look back at the recession in 2007, 2008, 2009, we had more of a prolonged period of lower deal flow. Our deal flow right now is lower, although not quite as significantly lower as we would have expected. So there's still things happening, and I do think that over the next 6 to 9 months there will be a lot of great co-investment opportunities that we're able to show your team.
Thank you.
Trustee Muyo.
No questions. Thank you, Casey.
Trustee Santos.
No, thank you.
Trustee Sanzeri. Trustee Sanzeri was having some technical difficulties. He was trying to switch over, so he might not be back on yet. So I'll come back to him. Trustee Votto.
Nope.
And I don't have any question. Drew, I think you were on mute last time we asked if you had a question.
Yeah, sorry, no questions. Good presentation. Yeah.
All right. Looks like Vince just jumped on. Can you hear us, Vince?
Yeah, no questions.
No questions? All right. Well, it doesn't look like we need to make a motion on this, but if there's no other, actually, Roberto, do you have any comments or questions?
No, I do not. Thank you, Andrew. I appreciate it.
And Harvey?
Nothing, thank you.
And Councilmember Foley?
Yes, yes, sir.
Do you have
I'm sorry I had to jump off. Did you ask
no
me if I
problem.
have any questions?
Yeah, do you have any questions?
I don't at the moment. Thank you.
Okay. All right.
Sorry, Andrew.
All right. Well, Casey, thank you for coming on. Thank you for the presentation. Definitely appreciate you doing that. Prabhu, do you have any follow-up questions or comments?
None at the moment, Mr. Chairman. If we can move on to C, I'd like to invite Steve McCourt and Laura Wyrick.
Good morning. Thank you very much. I hope everyone is safe and healthy. It's nice to see some of you by video. I am here with Steve McCourt, our co-CEO. He's going to provide a market overview and update. I know there's been a lot of exciting events lately, and also Chris Theodore, who will discuss a couple of items later on. So I'll turn it over to Steve to kick off.
That's great. Thanks, Laura. And I'm not sure, Laura, Chris, are you guys driving the presentation, or should I just relate to?
Chris has got it.
Great. Excellent. So, Chris, why don't you you turn to slide 4 in the presentation? I think it is. Yeah, I'll start here. I won't take up too much time before I hand it back to Laura and Chris to review your particular performance, but I did want to say a few words about the markets and both how they performed during the first quarter, which was historic, but also the rebound in the last couple of months, which has been more or less equally historic as the short bear market in the first quarter. First of all, related to the first quarter, page 4 shows the returns for the quarter for various indexes that represent different asset classes. You can see that the returns of equities were sharply down, particularly small cap equities represented by the Russell 2000 being down 31%. Emerging market stocks down 24% for the quarter. The S&P 500 down 20%. And these numbers were actually significantly improved relative to where they were in mid-March. You could probably add another 10 percentage points of decline if you rolled back the clock just a couple of weeks earlier. What caused the significant downturn in risk assets during the quarter, of course, was the COVID-19 pandemic and more or less the global shutdown of the economy to fight the spread of the pandemic. The movement of the U.S. equity market into bear market territory between February 19th and early March was the steepest, sharpest decline in the history of the stock market going back to the Great Depression. Starting in mid-March, the Federal Reserve and the U.S. government began rolling out a series of policy support measures that are too numerous to kind of go through in detail in this meeting. Suffice it to say that the amount of monetary and fiscal support that was announced in mid-March greatly exceeded that which the government provided during the 2008 and 2009 financial crisis, for good reason, that the economic consequence of the pandemic and the shutdown was in many ways multiples worse than the financial crisis in terms of unemployment. The rebound in the markets in the last couple of weeks of March has continued through April and May and early June. As we stand here today, the second quarter return, so the return of the S&P 500 during April and May and the first couple of days of June is a positive 27%. And as a consequence, we have just about erased all the losses from the first quarter in the equity markets. More shockingly, I think, if you roll the clock back 12 months from today, the S&P 500 is up 16%. 12 months ago, our economy was operating at more or less full employment. The unemployment rate was south of 4%. Corporate earnings were growing at a reasonably strong rate, largely on the backs of significant corporate buybacks. And investors were reasonably confident of continued growth in the economy and in equities. As we stand here today, it is likely that the unemployment rate will be in the range of 20 to 25% when it peaks out in a couple of months. The median estimate for the unemployment rate in May, which will be announced tomorrow, is 20%. It is likely that GDP growth in the second quarter will be negative 35%. The savings rate, which is the percentage of income that Americans save versus spend, has already reached 33%. To give you a sense of how abnormal those numbers are, a 35% contraction in GDP would be worse than any quarterly GDP contraction we had during the Great Depression. An unemployment rate of 25% would match the worst unemployment rate during the Great Depression. And the savings rate of 33%, to give a piece of context for that, has already exceeded the range that we've seen in the savings rate post-World War II, the range being generally between 2 and 8%. So I just want to highlight that because there's still a lot of economic pain. There's a lot of economic dislocation going on in the world. It was being reflected in March. It is no longer being reflected in the markets. And how the markets react from this point forward to continued shockingly negative unemployment numbers, continued negative GDP numbers, is really, really challenging to predict, of course. Markets are no longer trading on earnings. They are trading on expectations of a recovery as we move into 2021 and 2022. And they're trading based on expectations of continued fiscal and monetary support for the economy. Chris, if you move to slide 14, I want to talk about valuations briefly. This data is as of the end of March, which showed that with the March declines, the valuation of the U.S. equity market had been reduced, but was still over one standard deviation above the historical average valuation of stocks. As I just noted, the market has now gone back to roughly where it was on a valuation perspective. And this 10-year measure of earnings and valuation smooths out any kind of temporary impact from recessions and pandemics, for what it's worth. If you move to the next page, Chris, while we've seen valuations in the equity market ramp back up, what has been a bit different over the last couple of months is the movement back into stocks has been disproportionately favoring larger, growth-oriented, largely technology names so far, which incidentally are not the types of stocks that you would expect to recover if there were a true economic rebound. It appears that stock investors are migrating towards large growth stocks, partly because they see them as winners in a new normal of work and life where we all rely more on technology than we did before. If you look deeper into the markets on page 15, you can see that the small cap price to earnings ratio relative to the large cap is now cheaper than it's been at any point since the 1990s. So this is just a bit of a caveat to my prior point that yes, U.S. stocks are cheap, but not. U.S. stocks are expensive, but not all U.S. stocks. When you get beneath the largest growth-oriented names, valuations look more reasonable. And if you flip to the next slide, Chris, similarly in emerging markets and international stocks, you don't see the valuation expensiveness that you see in the U.S. Part of this is likely driven by continued investor behavior that perceives the U.S. as a safe haven during a period of crisis, which is normal historical behavior. The other piece of this is globally, we see this trend towards higher valuations for large growth-oriented companies. And the US is the home to the vast majority of large growth-oriented technology companies, San Jose being quite close to the home of most of them. So when you move outside the US, you're looking more at non-technology companies, which are cheaper generally. So in closing, the one thing I wanted to leave you with is markets moved down in historic fashion in March. Markets moved up in historic fashion the next couple of months. We're still early on, and when I say we, I mean investors broadly, in figuring out how to price stocks during this pandemic period. What we know for sure is that there's going to be continued really negative news on the real economy. What we don't know is whether the markets will continue to look out over the valley of that negative news into a hope for improved picture in 2021 and 2022, or if we will have at some point this year a retriggering of some of the fear and borderline panic in the markets that we saw in March. And so maybe with that, I'll stop and happy to take any questions that anyone has.
All right, thank you. Drew, do you have any comments, questions?
No, I don't. Great presentation.
Trustee Lee? Trustee Lee? All right, Trustee Menon.
Yeah, thank you, Andrew. Thank you for the presentation, Steve. So the one thing which I would ask is, these charts are very nice, and you show the U.S., you show U.S. small cap, and you show emerging markets. It'd be nice to have developed markets ex-U.S. That's also an allocation that we make.
Yeah, absolutely. We can. That's information that we capture regularly, and we can make sure to provide you with that information.
Thank you. That's all.
Trustee Muyo. Nick? Okay, it was very broken. I believe that you said you had no questions. Trustee Santos.
No, thank you.
Trustee Sanzeri.
Yeah, just one comment. Make sure I'm not coming through here twice.
You are a little bit.
Can you hear me okay?
Yeah, there's an echo, but we can hear you.
Let's see if I can shut that down. Sorry about that. Okay, so the question I have is related to the CAPE charts that you show. Do you have any of these charts that are inflation or risk-free rate adjusted? Because clearly we're in an environment where we're at historic lows in both inflationary rates and interest rates. And I think that these charts would look drastically different if they were adjusted for that environment.
Yeah, I would wholeheartedly agree. When interest rates are very low, it's all else equal, one would expect price to earnings ratios to be higher. So I think that's one of the rationales that stock investors have had in their minds in pricing stocks for the last couple of years, but even more so post pandemic period, because while we don't know what corporate earnings are going to look like for 2020, everyone has sort of has punted on that for this year. I think it's fairly safe to say that interest rates will remain quite low for a while, just based on Federal Reserve policy and communication of that policy. All else equal, it's appropriate for price earnings ratios to be a bit higher when rates decline. So what we'll do, Vince, is normalize some of this data for the level of interest rates in a couple of different ways, and follow back up. For the meantime, what I would conclude is the low interest rates may validate the valuations of U.S. stocks. Rates are even lower outside the U.S., so the low rate explanation, if anything, would probably magnify the valuation discrepancy between U.S. and non-U.S. stocks.
Thanks, Steve.
Yep.
Oh, sorry about that. It's on mute. Trustee Votto, you have any questions?
No questions. Thank you.
All right. The only comment I have is actually on slide 53, and Trustee Menace sort of referred to it, earlier in regards to data relating to end of April to see how we did. A lot of our sponsors, our membership have always been curious, about our performance compared to our peers and stuff like that. I just wanted to highlight, this slide 53, where it does talk about basically the 1 year, and it captures, pretty much the bottom, which was the end of March, and how our fund compared to the peers, and we were ranked in the 31st percentile. So which shows our defensiveness of our portfolio. I look forward to the next quarterly report to see how we did with the adjustments that we have made since that time. But I just wanted to comment on that real quick. Roberto Pena, do you have any comments, questions?
No, I do not. Thank you, Chair Gabinier.
Harvey Lederman, do you have any comments, questions?
No, thank you, Mr. Chairman.
And Councilwoman Foley, you have any comments or questions?
I'm good too, thank you.
All right. Well, if that said, let's go ahead and move on to healthcare.
Actually, we're not done with this item yet, Mr. Chairman.
Oh, I'm sorry.
That was an overview by Steve, and I believe Laura and Chris will take us through the actual performance.
Oh, I apologize.
Sounds good. Okay, so starting on page 25, just to provide a snapshot of first quarter performance specifically for the pension trust, the pension fund. The total value was $3.4 billion as of the end of March. That's an increase of approximately $417 million from the end of the prior quarter, despite some net outflows totaling $9.2 million. As you know, at your March 18th special board meeting, there was a new asset allocation policy adopted, and you can see that in the right column on page 25. You can see that the growth allocation is very close to the new policy. Low beta and other do not yet look like the new policy, mainly because there's still a large weight to short-term investment grade bonds and low beta. That new policy reflects investment grade bonds in other. Those are very similar allocations that will be migrated over time. In terms of changes to the portfolio, in terms of managers, there was during the first quarter a new U.S. index fund added, the Russell 3000 Northern Trust Index Fund, and also one new private real estate fund, DRA Growth and Income Fund 10. And also during the quarter, there were several strategies terminated, most of which were the commodity strategy, which is no longer an allocation in the new policy, and several of the hedge funds that were in the portfolio. So looking at the next page for performance on page 26, As your chair pointed out, peer relative returns look quite strong through March 31. If you look at the total fund performance for the quarter period, the first quarter, the fund was down 10.5%. For the fiscal year to date, that was at negative 5.9, and for the 1 year period at negative 3.4. If you look down below at the policy benchmark, the investable benchmark portfolio, the low cost passive portfolio, and also a 60-40 blend, the San Jose Pension Fund outperformed all of those benchmarks for the time periods of the quarter, the fiscal year to date period, and the 1 year period. And then if you look down at the rankings within the Investmetrics public defined benefit peer group greater than $1 billion, the fund ranked in the top quartile for both the quarter and the fiscal period, and in the 31st percentile for the 1 year. And those strong returns relative to benchmarks and peers were driven really across all asset classes. If you look down on the following sort of aggregates and composites, most asset classes were above their benchmarks for recent time periods. Highlighting a couple of managers in particular, we get to manager specific performance starting on page 30. If we look actually on page 32, one manager that I wanted to highlight was GQG Global Emerging Markets. GQG is a growth-oriented manager, and growth has done quite well relative to value recently. But if you take a look, since you hired them in July of 2017, they've lost about 60 basis points compared to nearly 4% for the benchmark and 5.2% for the peer group. So that places GQG in the top decile of emerging markets managers since you hired them. The portfolio manager there, Rajiv Jain, has been very opportunistic in terms of moving the portfolio during the first quarter to more defensive industries, and that's really paid off. I'll also point out on the emerging market side, the emerging markets debt allocation, that's on page 39. The total aggregate for San Jose's investments, which are two managers in emerging markets debt, ranked in the first percentile out of all of the peer group, which is the best, mainly because of Wellington Iguazu. You can see they're ranked in the first percentile for every trailing time period. That's a long short oriented emerging market debt manager. So their ability to short the space was very positive in a market environment where returns were negative for emerging markets debt, which really boosted overall portfolio returns. I'm happy to take any questions on specific managers, but the only other thing I was going to highlight is what your chair already did for me on page 53 around really strong peer relative both return and risk rankings for the first quarter. I will also mention before wrapping up that we have an estimate which is preliminary based on index performance recently. But as Steve McCourt talked about, we've had sort of a historic recovery recently, and we estimate that the pension is up nearly double digits for the quarter to date period since April 1st. We have an estimate of over 9% for the quarter return, which would actually amazingly push your fiscal year to date performance back well into positive territory with an estimate of 2.9% for the fiscal year to date period for the pension trust. So we at Makita would be happy to take any questions.
All right, thank you. Drew, do you have any comments, questions?
No, but Laura, I understand congratulations are in order, and thank you for joining us on our little fire drill last month. It looks like it paid off.
Thank you.
Howard Lee, any questions, comments?
Nope, no questions. Thank you for the analysis.
Eswar Menon?
Yeah, thank you, Laura, and congratulations on the new addition to your family.
Thank you.
So just one comment. So in terms of how the performance is presented, I was looking at the San Francisco retirement system. If you look at the annual report and look at the investment section, I think it's worth looking at in terms of how they present that performance. I think it captures, the overall performance in each asset class in an extremely, in a manner in which it's really shows what is happening to the to the plan and each asset class. So I think that's worth looking at.
Sure, thank you. We're always looking to improve how we communicate performance, so we'll do.
Thank you. That's all.
Nick, you have any questions, comments?
I don't have any questions. Thank you, Laura.
Trustee Santos.
No, thank you.
Trustee Sanzeri.
Just one quick question. On the current slide that Andrew brought to our attention, I'm a little confused on why the rankings on the Sharpe ratio and the Shortino ratio don't sit higher.
Yeah, that's a good question. I thought you were going to say you're confused about why the annualized standard deviation is presented as looking high instead of low. That's always confused me. And you have low standard deviation, but it appears in the chart to appear high. We can look into it. My guess is that the annualized return of other plans. If you look at the 25th percentile is -3%, but they do have much higher standard deviation than your fund as well. So it's something we'll look into the calculations on.
Great. No problem. Thank you. All the other time periods look good.
Trustee Votto.
Nope, no questions.
And I myself don't have any questions. Roberto Pena, do you have any comments, questions?
No, thank you, Chair Cadenia. Other than, once again, congratulations on the new addition to the family.
Thank you.
You're welcome.
Harvey Lederman, any questions, comments?
Thank you, no.
And Councilwoman Foley?
No, I'm good, thank you.
All right, thank you. Prabhu, do you have any follow-up questions before we move on to healthcare?
There's just one more thing I wanted to add, Mr. Chairman. You've seen, Laura did point out to the new policy targets for asset allocation, and I failed to mention this in the course of my oral update, but as you know, the city has decided to pre-fund contributions this year. And I believe for the police and fire plan, it's about 187 or 188 million. And so staff's intention is to actually mirror the revised approved asset allocation by the board and to deploy those assets according to our asset allocation. So where we'll have to true up a little bit to get closer to our benchmark, we'll use those funds to minimize transactions costs, but that is our intent. And we'll come back and report to the board in your August board meeting about how that deployment went.
All right, thank you, Prabhu.
Andrew, can I make one other comment?
Yes, go ahead.
I just wanted to bring everyone's attention to the cash flow page. I thought it was quite interesting where it showed the net cash flow for the last 3 years. It's pretty stunning, and this is why we carry this large cash balance in the plan. I'm trying to find specifically what page it's on. Page 50. For the 3 years, the net cash flow negative about $294 million. I think this helps explain why our plan at times needs to, not at times, but why specifically we carry that 5% immunized cash flow balance. So it's just an important point to bring to everyone's attention.
Thank you, Vince. If there's no other comments or questions, Laura, we'll go ahead and go to the next agenda item for healthcare.
Great, thank you. So I will move quickly given the similarities to the pension fund in terms of managers, but if you take a look at page 23 to start, the total fund was at 155 million as of the end of March. And you can see the current allocations were very close to the policy. As you know, the San Jose Healthcare Trust's assumed rate of return or expected return is the same as that of the pension, which is a bit unique among healthcare trusts. Many aim for a lower expected return and therefore have a more conservative asset allocation. But if you look at page 24, that's the reason for the not very attractive peer rankings. Typically in an upmarket environment during 2019, we saw really strong peer relative rankings for your healthcare trust, but in a down market environment, your healthcare trust is going to move more with the market and therefore didn't look as attractive relative to peers. We do expect that that has reversed since the end of March, given strong recent returns. So the healthcare trust return for the first quarter through March 31 was down 13.3%, outperforming the policy benchmark. For the fiscal year to date was down 8.4, and for the 1 year down 6.5, with the fiscal year to date and 1 year periods generally in line with the policy benchmark. As you know, the healthcare trust is invested very similarly to the pension trust, but in liquid managers, given the need for liquidity. And so manager performance is starting on page 26, but I won't go into individual managers given that they all are represented in the pension as well. Our estimate for performance since March 31st is a return of 11.4% for the healthcare trust. So really very strong quarter to date performance, which would bring the fiscal year to date to 2.1% as well. So happy to take any questions on healthcare.
All right, Drew, do you have any questions?
No, all good.
Howard, do you have any questions?
Just one question, maybe Prabhu, this is for you since I'm a little bit behind on background information. Is there a view towards the next 12 months on any kind of rebalancing or pruning within the trust?
We are constantly taking a look at this, Howard. So no plans as yet, but we will continually revisit the asset allocation for both the plan and healthcare as markets change.
Okay, thanks.
Eswar, do you have any questions?
No, I have no questions. Thanks, Tim.
Okay. Nick? I think that was a no, but you were broken up. Trustee Santos?
No, thank you.
Trustee Sansari?
No questions.
Trustee Votto?
No questions, thanks.
All right. The only thing I also wanted to point out, if you're looking at actually the slide that we are on, slide 20, is it 24?
26, I think.
26. Oh, if we go to, am I looking at the right one?
So 24 has the asset class composites and then 26 starts the manager specific performance.
Okay, so yeah, so the current slide that we have right now shows fiscal year for the healthcare down negative 8.4, and for the 1 year down negative 6.5. Just another thing I wanted to point out was, there's a lot of debate, amongst our peers and our sponsor and also our membership about, passive versus active. As you can see, this is completely a passive, portfolio. And if you want to compare this to our active portfolio, the passive portfolio is not performing as well as our active one, or as our regular pension fund. By a decent amount, and that's for fiscal year, 1 year, and 3 year. So I just wanted to, I know that's usually a hot topic debate, but just wanted to point that out. Roberto, do you have any questions?
No, thank you, Chair Gadanier. Thank you.
Harvey Lederman.
No, thank you.
All right, and Councilman Member Foley?
No, thank you. Good report.
All right. Thank you, Makita. Thank you, Laura. Excellent presentation.
Thank you.
All right, let's go ahead and go now to, we are on Prabhu, discussion action on the Alborn.
Thank you, Mr. Chairman. This is something that was discussed at the IC, and we're bringing this to the full board. I'm going to turn this over to Investment Officer Jay Kwan.
Hi, good morning. Hopefully you can all hear me. And I'll be brief, but I'll leave room, of course, at the end for any questions from any of the stakeholders here. So as probably noted, we covered absolute return at the last investment committee meeting. We gave some history as well as the structure of the allocation going forward. One thing I would note just for the broader audience here is that the consistency of the year-over-year shrinkage in the plan's usage of hedge funds has been very striking over the past 4 or 5 years. So to the point now where you'll remember back in March, you approved the strategic asset allocation that has just a 3% target to absolute return. As the memo, we posted notes for the contract. Alborn's been a great partner through both the building and subsequent shrinking of the absolute return allocation. Through that time, they've helped to make recommendations on managers. They've helped to craft the overall exposure profile of the allocation, and they did a lot of legwork involved in overseeing the very diverse range of strategies within absolute return. But now, at just 3% of plan, the program's at a point where we don't need a lot of those things anymore. All right, so going forward, we're planning on just holding a handful of funds, perhaps as few as 2 in just a couple months' time. So it's very unlikely at this point that we'll reverse course and bring forth any recommendations to add a new hedge fund strategy. And we've already crafted a structure for the allocation going forward. So what the new contract tries to do is adjust Alborn's service level. So our support needs, we need to adjust those to match the plan's lower utilization of hedge funds going forward. So under the new agreement, Alborn will continue to provide their investment and operational due diligence reports on the strategies we hold, and that's it. So they won't be making any recommendations on new strategies, and they won't be recommending that we redeem from any of the strategies that we hold. Their reporting is just going to be one of many inputs into our due diligence process, supplementing our own monitoring and periodic re-underwriting of the strategy. So let's say, for example, for a given fund, staff has access to the fund's exposures, risk analysis, and performance reporting, amongst other things. And as just part of our process, we have periodic calls with the fund to talk through all of those things. And Alborn also has access to similar data, and they use that to write their own due diligence reports. And so what this new contract does is it gives us access to those reports. But to be very clear, Alborn's reporting does not and would not replace or take precedence over our own due diligence. So their reporting is just one of many inputs into the formation, the creation of our own ultimate due diligence opinion. And I'm highlighting this because Alborn's not going to be operating under the same standard of care going forward. So instead of being a consultant that gives recommendations on changes, gives recommendations on actions with regards to strategies, they're simply going to provide continued access to their reporting. And again, that's just one of many inputs into staff's due diligence process. So in terms of the contract details, moving to this lower level of service will result in some fairly significant cost savings. All right, so Police and Fire has been paying $20,000 a month or $240,000 annually. Federated, just to note, has been paying the same amount. This new contract would be $5,000 a month or $60,000 annually. So we'll be going from 240 to 60. That's a reduction of $180,000 annually. We penciled in an 18-month term for the contract. but we have the right to terminate with 7 days notice. So this is basically a month-to-month contract. And that's important because as we noted, the absolute return program, the allocations changed a lot, has been changing. And so who knows, maybe we get to next year at some point and we find we need to tweak the service level again one way or another. So it's important that we maintain the flexibility to do that under this new contract. So in summary, the absolute return allocation is changing, basically shrinking, continuing to shrink, and our support needs around that are changing with it, right? Allborn's going to go from being an absolute return consultant to, in this new contract, simply providing reports on our existing funds and at a lower standard of care. So this lower level of service from Allborn will result in some fairly significant cost savings. I'll leave it up to questions now.
Thanks, Jay. Drew Lanza.
Nope, all good, thanks.
Trustee Lee.
Sorry, no questions, Jay. Nice job. I totally agree. Thank you.
Trustee Menon.
Yeah, thank you, Jay. Thanks for the information and appreciate the cost savings. So one question, I guess, as we move to basically at this point, I guess after redemptions, having one hedge fund and one alt-risk premium, would our main pension consultant, depending on who we go with, cover these, basically one hedge fund, I guess?
Yeah, so those are two different types of strategies generally, right? Depending on the general investment consultant, alt-risk premia is a topic that most of them, and certainly both Makita and Veris, they have opinions on and coverage on. The hedge fund, that's more in the realm of the specialty absolute return consultant space. And so, I would say, just speaking generally, the general investment consultants are kind of hit and miss in terms of coverage, whether they cover certain hedge funds or not. For the fund we're planning to retain, it's certainly broadly held enough that it'll probably be in some kind of coverage universe at some level. But the reason that this is normally Allborn's domain is because they specialize in that type of fund. So I think frankly, the broader question or the larger question will be if we end up just holding the one fund going forward alongside an alt-risk premia. At some point, do we need even just the continued reporting from Allborn? And so the reason we have this basic month-to-month structure in the contract is we're going to see how it goes. And if we get to a point where we feel like, okay, we have the transparency and access to the hedge fund that we need just from staff, and our coverage is capable at that point, then we have the option to shrink the Allborn relationship further.
Okay, that makes sense. Thank you, Jay.
Trustee Muyo. Trustee Santos.
No, thank you.
Trustee Sanseri.
No questions.
And I do not have any questions. So is there any public comments? All right, if not, we'll go ahead, and this is something that we have to take action on. I'll entertain a motion at this time.
Motion.
I'll make a motion.
Okay.
I think I heard Howard Lee first. Is that right, Howard?
Yes, that's me.
All right, motion made by Trustee Lee, and a
I'll second that
by Trustee Sanseri. If there's no other comments, we'll go ahead and take a roll call vote. Drew Lanza.
Aye.
Trustee Lee,
Yes.
Trustee Menon,
Aye.
Trustee Muyo. Shake your head. All right, there we go. That was an aye for him. Trustee Sanzeri,
Aye.
Trustee Votto,
Aye.
and myself, Trustee
No,
Gardner.
you skipped Santos.
Oh, sorry about that, Santos.
Don't let it happen again.
So is that an aye?
That's a yes.
Yes, a yes. All right. And then myself, Trustee Gardner, is an aye. So it passes 8-0. All right. Let's go down to the next item, F, discussion action on 2020-2021 private market pacing plan by staff.
Thank you, Mr. Chairman. Again, this was an item that was covered somewhat extensively at the IC, but here we are to present it to the full board for discussion and action, and I'll turn this over to Brian and Dinesh.
Good morning. So as Prabhu said, we will cover this presentation with more alacrity than was discussed before. Again, the purpose of this presentation is to get approval from the board on target level of commitments to deploy into our private market asset classes over the next fiscal year. This is the number that drives staff's discretion to commit to individual managers in an attempt to get to our target net asset value for the asset allocation. But to give some context to these numbers, because there are huge amounts of estimates that come into play when we forecast, is to provide a review of what we did over the past year and how some of the changes that we experienced both at the asset allocation level and in financial markets impacted where we are today. So at the highest level, effective the end of this month, we believe that we'll have completed 15 investments deploying roughly $206 million for police and fire. Essentially, we did exactly what we said we would do in our deployment comments in the pacing plan reviewed last May and June, in terms of the number of commitments and also the areas of focus within each of the private asset classes. One thing we have noticed is in improving quality in co-investment opportunities, and that will be a subject of discussion in the future, as we do not currently have the governance in place to execute quickly on those. Certainly, given the fact that we are doing this meeting by Zoom, there have been some substantial changes in the market environment that have made for a much more robust opportunity set across all areas of private markets, and changes in the asset allocation have impacted how we are positioned versus our targets and our forecasts going forward. And actually, I'll ask Dinesh to go over each of these in a little more detail.
Thanks, Brian. So if we move to the next page, this slide has some detail on the $206 million of expected commitments that are going to be made for the current fiscal year. It includes some that have been completed, as well as some details around things that are in the process, haven't been completed yet, but are expected to do so. Moving to the next slide, slide 5. This adds some color on the current market environment, which does have impacts to our portfolio, but it's really still too early to understand the real impact. During the Neuberger-Berman presentation earlier, you got a preview of how the Q1 valuations are looking like relative to other private equity firms. And broadly for our Q1 valuations for managers, apart from private equity, we're seeing a mix of funds that are being marked down, marked the same valuation as Q4, and in some cases even being marked up. The bottom of the page has an interesting timeline of the expected impact of the current market environment on various vintage years. And you'll notice that 2013 and earlier are going to be affected the most, and a positive impact on the 2017 to present timeframe is expected to have a better environment because managers do have capital that's available, and they're able to make new investments and capitalize on the current market opportunity. Importantly for our plan, we're well positioned because we do have a generally higher weighting towards the more recent vintage years. So there's significant amounts of dry powder where managers are going to be able to deploy that capital into new investments in the current valuation environment. Moving on to slide 6. This slide shows the NAV forecast for the next 10 years, which serve as the foundation for creating the pacing plans. I'll point out one change from last year is that while modeling this, we modeled the growth of plan assets using the asset allocation expected rate of return instead of the discount rate. We feel this is more appropriate since the current asset allocation does have a higher expected return than the discount rate. The chart at the top of the page shows the differences between the projections that were made last year compared to this year. And you'll see that the projections are more or less in line, slightly less than last year, mainly because of the market correction, but reasonably accurate. We also included both the current asset allocation as well as the contingent asset allocation throughout this report, just in case it gets triggered, so we don't need to come back to the board again for approval. I'll move to the next slide, slide 7, which provides some more details on the year-over-year changes in target private markets allocation. The key takeaway here is that the private markets target allocation in dollar terms is now about 20% less than what was forecast last year. This is mainly due to the asset allocation changes, which reduce the private markets target allocation, and also somewhat affected by the lower plan level net asset value. For the contingent asset allocation at the bottom of the page, the target is about 10% less than last year's forecast. Next, I want to jump to slide 10. And this chart looks very intimidating, but it's actually quite simple, and I'll try to explain it. So this is a graphical representation of our expected private markets allocation over the next 10 years compared to the allocation that we would need to be at the target weightings. So the expected allocation is the dark shading, and they also have the percentages listed in black text. The target allocations show up with lighter shading to the right of the dark shading. So these values do grow over time over the course of 10 years because we expect plan assets to increase into the future. And just to share an example of how to read this chart, I'll look at the dark red shading, which is the private debt asset allocation. And that's at the very bottom of the page. In June of 2020, there's expected to be a 4.9% allocation to this and a 3% target. So you'll see the lighter shading to be at a lower level. But over time, based on the new commitments that we make in the life cycle of funds as funds get returned to us, we eventually get to the 3% allocation. The following page also has the same information, but for the contingent allocation. So I'll skip that. If there's any questions, we can come back to it. Here on slide 12, we show the expected liquidity profile for private markets. This is something that's really important to consider because private markets are illiquid with an uncertain timing of future cash flows. Currently, we're building up the program, so still expecting to have more contributions into the program than distributions coming out of it. In our case, the contributions are coming from the Russell 3000 private markets proxy, which is serving to keep us at target weight until we're fully deployed. But over the next 2 years or so, the plan is going to be more mature and become self-funding, where capital calls are going to be funded by distributions coming from existing funds. Next, on slide 13, this shows the output of the pacing plan and the annual commitments going forward. This includes the results of modeling from Mikita, Neuberger, Berman, and staff. Neuberger, Berman did the private equity, staff conducted it for the venture program, and Mikita covered the final 3 private asset classes: private debt, private real estate, and private real assets. The column highlighted in yellow is what we're going to be seeking approval for today. This is something that we revisit on an annual basis. So even though there's expectations for future years, but we'll be back next year with updated results to get approval again. We also included the contingent allocation at the bottom of the page. I have one last slide that I want to cover before we come back to this one for approval. So if we jump to the next one, slide 14. Here I want to talk about the expectations for how we intend to deploy the pacing plan. Last year, we were able to provide a lot more transparency about the number of funds and types of funds that we expected to commit capital to. We also didn't expect to be active within the secondary and co-investment space. However, on the secondaries, we were somewhat active in the current fiscal year. But looking forward, there's more uncertainty, and I'll share some reasons why we don't want to put it on paper of exactly what we think the allocations are going to look like. The first point is that we've had consistency in our private markets investing over the last few years. The private markets portfolios are well positioned with the 2017 through 2020 vintage exposures, where managers have dry powder available and they're able to act on opportunities. So there's no rush to put capital out right away to take advantage of the current market environment. There's also no obvious gaps in the portfolios that we're looking to fill. Secondly, we have a smaller dollar value that we're looking to deploy compared to last year, mainly because of the asset allocation changes. And there's also a shifting supply and demand balance where our capital is becoming more valuable. And there's opportunities where we're able to get potentially better investments than we had before. Lastly, we think that there's going to be more secondary and co-investment opportunities that could be compelling. You heard from the new brewer presentation earlier that over the next 6 to 9 months, within the buyout space, there's going to be likely more. And we expect throughout private markets the same case. There's no guarantee this will happen, but it's something that we're actively monitoring. At the investment committee, we did share some specific examples of deals that we'd looked at, nothing that reached the level that we wanted to bring forward, but something that we have our eye on. So to sum it up, I would say we're going to be patient, but actively seeking out opportunities and ready to act whenever they do present themselves. And with that, I'll pass it back to Brian for wrap up.
Elaborating for just a moment on what Dinesh was saying about our approach to the market, one of the key benefits of the discretion that's been delegated to staff with respect to selecting investment managers has meant that we're able to have a very clear dialogue with potential investment managers about what we can offer. And along with that comes the knowledge that we're going to negotiate pretty tough to get the best opportunities and best deals for the plans. And that is something that we're very keen on activating, particularly in the latter half of the year, as some of the fundamental concerns that Steve McCourt mentioned in his comments come to the private markets as well. So I've moved the slide back to the recommendation slide and happy to take any questions at this point.
Thank you, Brian and Dinesh, for the presentation. Trustee Lanza, any question, comments?
No, good job, thanks.
Trustee Lee.
Brian, Dinesh, thank you for the presentation. Well done. I do have one question, and I think, Brian, you mentioned it earlier on co-investment and the fact I think Dinesh highlighted increasing number of attractive opportunities in Q4. Do you have any points of view on how you may approach the resourcing in dealing with these co-investments, given the timing issues of some of these deals?
Yeah, so the process that we go through when evaluating a co-investment does start with the feasibility of the timeline. Can we execute? Can it be sized correctly within our portfolio? And can we do the appropriate level of diligence? We tend to go one step further also on the screen and try and evaluate whether or not we actually have an edge. One thing that we don't want to do is be adversely selected and be offered the opportunities that are larger because they're less attractive. So I think for us, as we evaluate co-investments, that is top of mind, is one, on the speed, and two, on the positioning in the portfolio, and three, what's our edge?
Great, thank you.
Trustee Menon.
Yeah, thanks for the presentation, Brian and Dinesh. Good job, thank you.
Trustee Emilio. All right, he doesn't have any. Give me the head shake. Trustee Santos.
No questions, thank you.
Trustee Sanzeri.
No questions.
Trustee Votto.
None, thank you.
And myself, Trustee Gardner, does not have any questions. CEO Roberto Pena, you have any comments, questions?
No, thank you.
Council Leaderman.
No, thank you. Excellent presentation. Thank you.
And Council Foley.
I'm good, thanks.
All right. Any public comments? All right. Since there's no public comments, we'll go ahead. I will entertain a motion for approval.
So move, Santos.
Got a motion by Trustee Santos.
Second by Howard.
Second? second by Trustee Lee. We'll go ahead and do a roll call. Trustee Lanza.
Aye.
Trustee Lee.
Yes.
Trustee Menon.
Aye.
Trustee Muyo. Muyo gave us a thumbs up. He's having some audio difficulties, so we're seeing his motions through thumbs up and down on the video. So that was an affirmative for Trustee Muyo. Trustee Santos.
Yes.
Trustee Sanseri.
Aye.
Trustee Votto.
Aye.
And myself, Trustee Gardner, aye. So that carries 8-0. Thank you, gentlemen.
Thank you.
All right, so we'll go ahead and go to G, discussion actions to authorize the secretary to negotiate and enter an agreement for consulting services. Prabhu.
Thank you, Mr. Chairman. So as the board knows, this is for investment consulting services. We issued an RFP a few months ago, and we completed the work of evaluating the RFPs. And we did have a question which we took to the IC for clarification, and the IC provided us with some guidance. And now we bring to the full board our recommendation. To give some background, we've had Makita as our general investment consultant and Veris as our risk consultant now for the past few years. And staff felt that perhaps we can when we issue an RFP, we can do one RFP for both general consulting and risk consulting services, and which may perhaps save some money for the plans. And so with that intention, we did issue one RFP. We got 3 responses back from both our incumbents, Makita and Veris, as well as from another firm, RV Coons. And then staff sat down and read through the RFPs, evaluated the RFPs, and scored them. And RV Coons actually finished 3rd. They did submit a very strong and competitive bid, but in our ranking process, they did finish 3rd. And both our incumbents, Veris and Makita, finished, scored very highly and finished very close to one another. And so the question in front of us, which we posed to the IC, was that if you look at their existing contracts, we actually pay $975,000 for both consultants for both plans. And the RFPs that we received from both those plans, from both those consultants, was about $800,000 for both general investment consulting and risk consulting. So the question we posed to the IC was, should we actually go with one of those consultants, because that could save potentially $175,000 for the plans, or should we go with both consultants in some form or the other? And it was staff's recommendation that even though we evaluated both consulting firms individually, we felt that the services of both consulting firms added something more over and above what one consulting firm could bring. And so the question was, is that added value and advice worth the additional $175,000? And so the IC gave us the IC felt that if staff felt comfortable with both consulting firms and there was value added, that staff should probably pursue along the lines of perhaps hiring both consulting firms, and gave us the latitude to negotiate with those firms for some cost savings. And the IC also pointed out that even though our general consulting services may cost a little bit more, staff had actually saved a substantial amount in renegotiating its contract with Alborn to the tune of $360,000 across both plans, as well as in choosing a new custodian. And you'll hear from on that in a few minutes, where there was also significant savings of up to $500,000. And so with all that in mind, the IC gives staff latitude to go back and talk to these firms. And essentially the recommendation that staff is making after talking to both firms, and before I get to that, I did share this with the IC. I want to share this with the full board. Both consulting firms, Makita and Veris, have done a tremendous job for the plans. They've been great partners for both the board as well as staff. And in particular, both lead consultants ranked very highly, Laura Wyrick and Eileen Neal, and congratulations to them both for being wonderful partners to us. And so Makita came back. We negotiated with Makita, and Makita came back. And what Makita offered was, so the current rate is $680,000. And Makita offered to continue at the same rate of $680,000 for 3 years with an additional, with an increase if, and it is staff's intention to go back and issue an RFP within 3 years. But if it were to go beyond 3 years, Makita requested a 3% increase in their fee, which staff felt was very reasonable. But what staff was able to negotiate with Makita was, as of now, in our contract, Makita provides 3 due diligence reports for private markets included in the $680,000. And what staff was able to negotiate was to increase that to 6 reports. And each additional report in our existing contract costs $35,000. So we are getting essentially for an extra $105,000 worth of services from Makita for the same rate of $680,000 per year. And also staff had some other...
wait, I hear Q George Floyd. Yeah.
21st century, everybody.
Linda, I think you can mute everyone and then just unmute the people that need to talk.
I tried that.
It's happened to me before, Linda. It's irritating.
I've muted everybody, but some people have unmuted. Okay, good.
There you go.
All right. I was always wondering what Zoom bombing looks like, and I found out.
And here's like, yeah, sounds like it.
Yeah. Sorry for that disruption.
Not a problem, Barbara. It wasn't your fault. I guess it happens. So to continue, where I was with Makita. So we're continuing with Makita at $680,000 a year with an additional services thrown in with a value of $105,000. And with Veris, staff was able to actually negotiate the fee from $295,000 down to $250,000. And so that's a savings of $45,000. And in addition, Veris also has promised to give us access to their manager due diligence whenever we require them, perhaps a manager that Makita does not cover, or if we need a second opinion, they are going to actually give us access to their manager due diligence, which is, you cannot put a dollar figure on it, which is quite a lot. And also with both Makita and Veris, staff insisted that the lead consultants be named in the contract, Laura Wyrick and Eileen Neal respectively. And if there's a change to the lead consultant, that staff gets a chance to approve whoever is appointed in their place. And both firms have been extremely flexible, willing to work with us. So our recommendation is in the memo, and I'm going to go open the memo 2G. You will see recommendation A and B. And so staff recommends awarding Makita Investment Group a 2-year contract. The only thing I'd add to that, the language in that recommendation is that if Makita is hired beyond 3 years, that we agree to give them a 3% raise. But the rest of it is as it is shown in this memo. And with that, I'm happy to take questions.
Andrew, are you there?
Yeah, sorry about that. I thought I unmuted myself. Trustee
Okay.
Lanza, you have any comments?
Yeah, so let me give you a report out from the investment committee when Prabhu brought this up. So Prabhu said, the staff would like this. Okay, but let's remember as a board that this is not a theoretical construct of having Makita and Veris working together for us. Take yourselves back to that last offsite, that really good offsite that Vince and Andrew gave us at the Hayes Mansion. And the question that was asked was, okay, how do we pick a risk to target for our portfolio? And then how do we actually pick the actual number risk? And if you put yourself back in that room at about 2 or 3 p.m., we've got Veris making a presentation and Makita constructively riffing on the Veris presentation. And the two of them and our board putting our heads together, we walked out of that meeting with a concrete number for risk and a rationale for how we got to that number. So this is not a theoretical construct of putting these two together. We've done it. We've been doing it for a while. Staff says it's working for them. More importantly, the board did it at that offsite. And really good job, by the way, Vincent. That was a great offsite, you and Andrew. So we know this works. So I think I can speak for all the investment committee. We are very heartily in support of this.
Thanks, Drew. Trustee Lee.
Yeah, thank you, Prabhu, for the overview. I think it makes a lot of sense given, as you call the 1 + 1 is greater than 2 with the added experience and the complementary skills that they have. So I look forward to more work from the two firms. Thank you.
Trustee Menon.
Yeah, thanks for the presentation, Prabhu. I think what you suggest makes a lot of sense. Thank you.
Trustee Muyo. No. Okay, that's a no for him. Trustee Santos.
Yes, thank you.
Trustee Sanzeri.
Just a great job by staff doing the RFP. Really happy with the outcome, and great job in working with both consultants to come to a good solution.
All right, Trustee Votto.
I'm in agreement.
All right, and myself, I have no comment. I believe the RFP went really well, and I concur with staff's recommendation. Is there any, Roberto or Harvey, you have any comments?
No, I just want to, again, thank staff for their work in this process. Thank both investment consultants, not only for the work that they have done for both boards over the years, for their engagement today. And I do as well support the recommendation by staff. Thank you.
Yeah, I'd like to endorse that as well. From a governance standpoint, I just want to give a shout out to the investment committee and staff. The investment committee put a great deal of trust and confidence in staff's handling of the RFP and ability to negotiate on behalf of the plan. And I think this is a terrific outcome. I think staff had absolutely the best interests of the plan in mind, and their negotiations were quite successful, and we've saved a lot of money and gotten a lot of terrific services that the board really wanted. So big shout out to everybody on how this was handled.
Thanks, Harvey. Councilwoman Foley.
No, I'm good. Thank you.
All right, thank you. Is there any public comments? All right, if not, we'll go down a roll call list. Trustee Lanza?
Do we need a motion?
Yes, sorry about that.
I'd like to move, Andrew. I'm a big supporter of this.
And Drew, does your motion include the 3% kicker raise?
Yes.
Okay, outside of the after the 3 years.
Prabhu discussed.
Yes.
Yeah.
Okay.
Yeah, and then keeping insurance law, yeah, right, making sure it's right, all that stuff. Smartly negotiated, Prabhu.
I'll second that motion.
All right, so we got a motion by Trustee Lanza, a second by Trustee Sanzeri. But now we'll go ahead and do the roll call. Trustee Lanza. Trustee Lee.
Yes.
Trustee Menon.
Aye.
Trustee Muyo. There. That's a yes on Trustee Muyo. Trustee Santos.
Yes.
Trustee Sanzeri.
Yes.
Trustee Votto.
Aye.
And myself, Trustee Gardner. Aye. So that motion carries 8-0. Thank you, staff, for the RFP. Look forward to working with Makita and Veris for a few more years. Definitely appreciate it. Definitely have a good relationship. So thank you.
Chair Gardner, this is Laura at Makita. If I could just say thank you very much for your continued confidence. The relationship with the city and both boards and the staff is very important to Makita, and we'll do our best to continue to serve you to the best of our ability.
You rock, Laura.
Thank you, Laura.
Thank you.
All right, so we'll go ahead and now move to item H, discussion and action on authorizing the secretary to negotiate and enter into an agreement for custodial banking services.
Thank you, Mr. Chairman. Again, on 2G, thanks to the board for all their support. On 2H, again, custodian banking RFP, long time in the making. We've had a custodian for many years, and this search was actually led by Makeda, and this was discussed at the IC. I'm going to turn this over to Chris, Laura, and Ron.
Great, I'm going to share my screen. We're going to start with the Makeda presentation, item 2H2 within the custody search. Just for a little background on the custody search, this was discussed at the IC, but we did want to touch base on all the points and take any questions you may have. But in January 2019, staff and Makeda issued the request for proposal for custody services. The next step was staff and Makeda evaluating the 6 resulting proposals that we received. Then towards the end of 2019 in December, selection committee from staff as well as Makeda was able to interview semifinalists, followed by on-sites conducted by staff in early 2020. So a very diligent search process from both staff and Makeda. And San Jose staff and Makeda worked to arrive at 3 finalists, those finalists being State Street, Northern Trust, and BNY Mellon. As a reminder, on page 3, on selecting a custodian, exactly what a custodian does, the primary service is in the safekeeping and recording of assets. Flipping through to page 4, we have an overview on each of the 3 firms, State Street, Northern Trust, and BNY, all 3 of which are large publicly traded banks with high credit ratings and stable Tier 1 capital ratios. We continue through to page 5. We break down some of the firm statistics in regards to custody. All 3 of the firms have a significant majority of their revenue provided from the custody business, showing dedication to the space, and are 3 of the leading players. State Street with 83% of its revenue coming from custody, Northern Trust 63%, and BNY 75%. Public funds make up a varying proportion of those assets, with State Street being 11%, Northern Trust being 22%, and BNY being 6%. And each of the 3 banks having a large amount of clients in the same size range as the Federated and TNF clients. Page 6, we look into the services that each of the 3 banks provide. Each of the 3 banks provide very similar services, with statements arriving in similar times, similar reporting systems, and similar insurance coverages. Lastly, we look, I'm sorry, not lastly, but in client servicing, we look at the 3 banks. We noted the coverage teams that would be provided for each of the 3, with State Street's coverage team being based out of Kansas City, Northern Trust out of Chicago, and BNY out of both Los Angeles and Pittsburgh. And lastly, we look at the fee summary for each of the 3 plans. We'll note, in deferring to Ron, who's going to speak next, I believe State Street did come in with an updated fee level, but you'll note that here in this fee summary that was provided, State Street was significantly higher than both Northern Trust and BNY. Northern Trust and BNY both in a similar ballpark in the mid to high 400,000 ratio. And also, we'd like to note that these are estimated fees based on transaction and account levels that had taken place in the past. There might be minor differences in what you actually experience going forward, but with BNY being the cheapest of the 3 providers at roughly $450,000 per year, providing a significant cost savings from what you're experiencing with State Street currently. And with that, I'll pass it over to Ron for any comments you might have.
Hi, good morning. Just wanted to give you a quick background on State Street. State Street was the plan's custodian since the 1990s when there were bank distress and went through a few acquisitions. During the RFP process, we received 6 responses, and we narrowed that down to 4 candidates and interviewed 4 of those candidates and did on-site due diligence of 2. You see the rankings in the memo. The key factors in the rankings were, one was the kind of service team, how responsive they were and how accurate information was provided, the technology, the web portal, the accounting processes, and also the statements and how they're broken out and how it was easy for us to interpret. Just a couple of developments that happened in the last couple of days. Station came back with the revised fees after they saw the memo posted at the IC meeting. For police and fire pension, they quoted 200,000, and for police and fire healthcare, they quoted 25 at 225 total compared to BNY Mellon of 243. As I mentioned earlier, that the key factor is the service that they're providing to us, and staff felt that even with the fee collection, it would be difficult to assess how they will change the services, the technologies, and provide the service that we would be getting from BNY. With that, I'll leave it to you for any questions.
All right. Trustee Lonzo, you have any comments, questions?
No.
Trustee Lee?
No questions. Thank you for the presentations.
Trustee Menon?
Yeah, thank you, Ron, and thank you, Chris, for the presentation.
Trustee Muyo? No questions for him. Trustee Santos?
No, thank you.
Trustee Sinceri?
No questions.
Trustee Votto?
No.
And I do not have any questions. Any comments from CEO Roberto Pena?
No, no comments. Thank you.
Council Liederman?
Yes, just briefly, for the record, Mr. Chairman, I want to BNY Mellon is a long-term and strong client of my firm, Reed Smith. The Mellon Bank relationship goes back to Pittsburgh, where the firm was founded in the middle 1800s. And so I have intentionally had no communications with anyone relating to the RFP or the selection recommendation of BNY Mellon, and would just, I've recused myself from any participation in that matter, and I just wanted to put that on the record. Thank you.
I appreciate that. Thank you. Councilmember Foley.
Just a quick question. Who is our current custodian?
State Street is our current custodian.
Okay, so we're looking to make a change. All right.
Yep.
Thank you. I appreciate the recommendation and the report.
Thank you.
All right. Any public comments? All right. If not, I would entertain a motion.
So move. Santos.
I got a motion by Trustee Santos.
Second by Howard.
A second by Trustee Lee. All right. Roll call. Trustee Lonzo.
Aye.
Trustee Lee.
Yes.
Trustee Menon.
Aye.
Trustee Muyo. I've lost you on your screen. Okay, there it is. Okay. That's a yes for Trustee Muyo. Trustee Santos.
Yes.
Trustee Sinceri.
Aye.
Trustee Votto.
Yes.
And myself, Trustee Gardner. Aye. So that motion carries 8-0. Thank you, Ron.
Thank you.
All right, so that moves us to, there is no old business. So we'll go ahead and jump to new business for a oral update from CEO of Retirement Services, Roberto Pena.
Yeah, thank you, Mr. Chair. I hope all of you received my email from last Friday, providing you with an update on the operations at the Office of Retirement Services And I just wanted to sort of summarize my email here in public this morning, letting you know that we had a quarterly staff meeting with the full staff of the Office of Retirement Services through Zoom last Friday. I thought it went very well. It was really nice to see some faces I haven't seen in about 3 months. And the agenda was also included on my email to all of you. But what I wanted to key in was in the one item related to COVID-19. My email also included issues that we are taking in consideration whenever the shelter-in-place order is lifted and we start our way back to the office. Just wanted to share with the board that our overriding factor, whenever that takes place, is the safety of our employees. And of course, when we are once we open the office for members, then the safety of our members as well. We have a meeting, I have a meeting scheduled with a group from the city next week, where they're going to be discussing some of their plan for returning to work at some point. So I will have more information for you, board, after next week. But in the meantime, I also wanted to share with you that, again, because our overriding factor is the safety of our employees, I'm also in full support, and so is senior staff, full support of continuing the current approach of working remotely to obviously to be able to complete and implement the core duties of our office. And whenever the shelter-in-place is lifted and we kick off our planning along with the city and going back to the office, I suspect that it will be a phase-in approach where we will not be having all the members at the same time. So bottom line is, I still have a meeting with the city on the planning, and we're going to continue supporting the working remotely. And in addition to that, in my email, I kind of gave you a little background as to what each one of our divisions have been doing. Bottom line is, we have been doing a very good job of working on our core duties. And so, as you know, investments have continued working on implementation of the asset allocation changes, and obviously meeting with potential managers and bringing forward some recommendations on managers, as we discussed this morning in the meeting. And as you know, we have continued having the board meetings and committee meetings, and they're not easy. A lot of things happens in the background, and as you saw this morning, we were hacked, and staff were able to quickly neutralize that. So again, very excited, very happy that our office staff has remained engaged throughout this process, and a big kudos to all our office staff on the work that they have completed. But I wanted to close it by letting you know that as we provided some of the thoughts that we're having about our approach whenever there's a decision that we start thinking about going back to the office, as we provided a list of those issues for you, board. If you have any questions, recommendations, or thoughts, please feel free to reach out to me. Second, I wanted to also let you know that the recruitment for the one position of your board that is open right now was completed, and the city is actually working right now on when they're going to schedule the interviews. The city next 4 meetings, which are June 9th, 16th, 23rd, and 30th, are very, very full, as you can imagine. I believe the interviews at this time have been scheduled for the June 9th meeting. So I will keep you posted if the interviews take place and what the recommendation by the city council is at that point. And lastly, I wanted to let you know that we started already working on the financial audit for June 30th, 2020. With that, that concludes my comments, Mr. Chair. I'm happy to entertain any questions or comments.
All right, thank you, Roberto. If anybody has any questions, just go ahead and speak up. See a no by Drew. I'm looking at everybody's pictures up there. No for Nick. Okay. All right. Well, thank you, Roberto. Let's go ahead to 4B, oral update from City Council Liaison, Pam Foley.
Thank you. Before I forget, Roberto, I don't think it's on the agenda. The interviews are on the agenda for June 9th. I just took a look at the agenda and I don't think it's there.
Well, yes, I mean, you may be right. It may be the 16th. I was in agenda review for the city yesterday, Wednesday morning, and I'm trying to think quickly. I think you may be right. It may be June 16th, so I apologize.
Yeah, that's okay. I just reviewed it and I didn't recall seeing it, so I just wanted to throw it out there. It's been, just regarding my report, it's been a lot of, lots going on, as you all been reading in the paper and maybe even experiencing yourself in the last week, and then even 2 months before that in starting shelter in place. So we're all in shelter in place, as you all know, and COVID is still a huge issue for us, but the protests and the curfew and as a result of the murder of George Floyd has created additional stress and anxiety for our community, and we're working through that. There's a press conference today at 1 o'clock with the police chief and the mayor and the city manager about the curfew and how we're going forward. The council did move to, a curfew was established on Sunday and was to go through the week, but in a session on Tuesday, we modified that to cancel the curfew as of 5 a.m. this morning. But the council is on alert to if the chief and city manager feel the need to go into curfew again, then the council will meet and confer and make that decision in an emergency session. All very disturbing, and as you can imagine, very stressful for both the protesters, the racial injustice that we're seeing, and how the community is responding is a very difficult thing that we really need to resolve and come together peacefully, but come together and resolve the racial injustices. But that doesn't mean we still don't have problems at the city. We do. That's one of them. The other is our budget is still at a deficit of, we're short about 70 million, which we're working to firm up through next budget. Trustee Franco asked me about the Hire Ahead program, and last meeting I said it wasn't on the table, but when I actually got to the budget meeting in the next couple of days, I learned it was on the table and was unfunded in the budget, but now it's been added back in because we have it all depends on our reimbursement and funds available from the CARES Act and FEMA reimbursements and funds that we are getting, and so we're able to offset some of the costs with and add back in the Sworn Ahead program in the new upcoming budget cycle. So I wanted to give that information as a heads up to you. From a shelter in place, you've probably been hearing that the good news is that part of the shelter in place will be lifted tomorrow, which will put more of our businesses back in business, and that's a good thing. There are provisions for that. You know, we're all looking for people to get back to work because I think that takes away folks' anxiety on not being able to contribute to the finances of their homes and being stuck in their homes trying to cover their expenses when they're unable to do so. So the shelter in place is having that lessened is good. Personally, I'm getting tired of being at home and Zooming my meetings, although I like not having to get into my car, but I miss having the personal contact, the direct one-on-one. That really is difficult for me, and I'm frankly getting tired of it, but I honor shelter in place and I know why it's all there. The city is still responsible for distributing food, although we have bore a tremendous expense in doing so. We are currently in negotiating with the county for them to assume some of the responsibility, because we are being notified by FEMA that we will not be reimbursed for those expenses related to food distribution that do not directly affect residents of the city of San Jose. So that means we took on a big expense, not knowing or anticipating that we'd get reimbursed, but we're not. So now we're in negotiations with the county, and where those go, I don't know, but we are hoping that they will pick up the difference between what we will be able to get reimbursed for and what not. That's all important because that impacts our general fund. It impacts our ability to pay our unfunded liability. You already heard we're pre-funding our unfunded liability or our obligations, which is an important tool that we're using. But about the foods, I wanted to say that we are distributing or causing to be distributed 2.75 million meals a week, and that's an increase of about 2.5 a week ago. So the need is still tremendous out there. Regarding face coverings, there was a recent ordinance, the urgency ordinance that the city passed. It pretty much mirrors the county's ordinance regarding face coverings. They are required in all public places. Really, the major variance, two major variances, and one I had trouble with, so frankly I voted against it because of this. It's not because I don't support face coverings. I absolutely do. I wear them myself. But I felt the county already had their regulations and ordinance, and we didn't need another one, particularly because the ordinance needs to be implemented or imposed by PD, and we don't have the resources for police to deal with that. I don't believe imposing another regulation that either the police cannot or will not enforce. And I'm not saying they should enforce. I think it's just not a good use of their resources right now, but doesn't mean they won't be called in occasionally to enforce it if someone is upset about someone not wearing a mask and face covering in public. So the main difference between that one and ours and the city or the counties is that when you are standing in line outside, say you're in line at Safeway to get into a store or Trader Joe's or someone like that, you must wear face covering while you're standing in line. That is not the restriction under the counties. They're kind of vague on that, but it's specific in ours. Lastly, I'd like to leave you with just an update on Measure T. Measure T is a tax that we implemented a couple of years ago, and while there's a lot of provisions that affect the environment and other things, the two issues, or the one issue of importance to you, is that the Fire Station 37, which was approved in Measure T, it is moving forward, slightly delayed, but not tremendously delayed. And in the budget, we're fully funding staffing that as well. And there are other fire stations. Unfortunately, I didn't write them down. I remember 37 because it's really close to my house. So when that gets built, that's the one that will help me out if I have any issues in my home. So that's why I know in my head 37. But I know we're also looking to build two other new fire stations. Andrew, you probably know, but we're looking for real estate for one of them. So all of those things are going forward thanks to the voters approving Measure T and thanks to the funding that's available through that. So concludes my report, I think. Thank you. And also, if there's anything you'd like me to report at an upcoming council meeting, please let me know. That would be helpful.
All right, thank you. Thank you very much for the report out. Does anybody have any questions for her? If you do, go ahead and speak up.
A comment, Andrew?
Yes, go ahead, Vince.
First of all, Councilmember Foley, I really appreciate the thorough update that you provide for our board. It's refreshing to receive that from a liaison. Secondly, your question about if there's anything you'd like us to report, since we just went through our quarterly report and just experienced a very difficult downturn in the market, I think it would be nice to spotlight or highlight how the plan performed during a very stressful time and how well it did during that environment. And the fact that we've continued to talk about positioning defensively and how that's helped us during this period of time.
Vince, I appreciate that. That's great. Roberto, maybe you can help me with what language would be useful to report to the council.
Sure.
Or whoever.
Councilmember Foley, I mean, that would be something that could be much better explained by Prabhu, but I just wanted to let, trustees and service request is certainly right on target. And maybe Prabhu and I should have mentioned this to the board sooner in his report, my report, but I have reached out to Prabhu and we have been discussing about, we were just waiting for the data from Nikita for Prabhu to issue a second information memo to the city council to provide the council with more updated returns and providing a little background on how the market changes had transpired over the last few months. So Prabhu, I'm not sure if there's anything that you want to add to that.
Thank you. Thanks, Roberto. Thanks, Vince and Councilmember Foley. That's exactly right. We were waiting for the official performance numbers before I wrote my memo. And now that we have that, that should be forthcoming soon.
Great. And if, to save you time, if you don't want to do an extensive memo, if you just want to give me some bullet points, that would be very helpful to me because I would certainly want to capture it accurately, particularly in case the mayor or any council member asks me a question about it.
I'll be happy to do that for sure.
I appreciate that. Thank you. I'd love, there is an opportunity on the June 9th agenda if there's a standing item on our agenda. So if you can get it to me before then, that would be really helpful if that's not too much of a time pressure for you.
No, that's certainly doable. I'll reach out to you. Thank you.
Wonderful. Thank you.
I know there has been a further discussions. I wasn't sure, Chair Gadenier, if this was a good time to ask the public for any comments or questions on everything that has been reported.
Yes, thank you. I was going to just see if there's any other trustees that have any questions for Councilmember Foley before moving to public.
I actually, this is Howard. Councilmember Foley, thank you very much for your updates. I find them super helpful because not only do I get more insight into the city, but also I see the impacts with respect to the work that we're doing here with respect to the police and firemen. So thank you for your updates.
I appreciate that. Thank you.
Any other trustees?
Andrew, if I may ask a quick question, Councilmember Foley. One of the things as we monitor COVID around the world is that certain countries have done very well. It seems like that tracing is at a very high level. Has San Jose reached a level where you're satisfied that if you get another outbreak, that it can be handled quickly?
That's the $1 million question, I think. I think, so we fall under the control of the county health director, Dr. Sarah Cody. So she has been systematically making these easing changes to our shelter in place in a 2-week strategy. So she, on Friday, tomorrow, things are easing up a little bit. Then she'll look at the the numbers of positive testing and also the number of deaths to see if they're increasing. And fortunately, the number of deaths that we're seeing from COVID are fairly low. But that doesn't mean we are preparing for a future surge, and the hospital capacity and emergency capacity is very good right now. And that is because the county is being very strategic and careful about the release. What the three things that have to happen, or two of them I can name off the top of my head, and I can't remember what the third, if it comes to me, I'll get it, is tracing and testing. Oh, vaccination. Of course, vaccination's the third, but where that's a longer way away. The testing is increasing capacity tremendously. So the more we test, the more, and now there are opportunities for folks to be tested whether you have symptoms or not. There's a lot of sites available in the city of San Jose and the county that you can go to and get access to testing for free. It's not the antibody test, it's just will determine whether you have COVID currently. That's one thing that's important. The tracing is the second thing that's really important. And other countries have been really good at tracing. We are trying to step up the number of tracers. We, the county, I should say, is trying to step up the number of people who can trace the COVID positive contact. And that's really important because then we can find out who they've contacted and then and find out their sphere of all the people who've been contacted to someone who has tested positive. But those numbers of people who have applied, we're looking for several hundred people who can help with the tracing, and we have less than 100 people who have applied for the job. So we are looking for people who are interested in tracing, and that's available on the county's website. I can actually get you a link to some of that information if that would be helpful, but it's really the tracing and the testing that are really, really critical. The county has done an excellent job and then PPE, the access to the personal protection equipment is really critical in maintaining the supply that we need. So I know the county is very involved in that. The city is as well. We're doing, everyone projects because it's a summer that the heat will benefit COVID virus. I don't know if that's going to happen or not. People are anxious to get in groups again. But whether we've resolved it, it probably hasn't. I've heard several people refer to this as a V curve economically, that we're going to come down and back up. Let's hope that is the case. As far as the disease or the pandemic itself, the county seems prepared, but they're being thoughtful and conservative. And some would say overly cautious. I've been one of those, but I understand the thinking behind it and I support the decisions. That was a long answer to your question. Did that get to where you were going?
Yes, yeah, thank you, appreciate it.
Okay, thanks.
All right, any other questions from the trustees or staff? If not, we do have one public member, Beekman, who has a question for Councilmember Foley, I believe. Public member Beekman, can you hear us?
Yeah, hello. Am I unmuted now?
Yes, we can hear you.
Thank you. Yeah, this is my first time attending this meeting. It was very informative and interesting for me. I just wanted to thank Councilperson Foley's work. She's been working really well this past week to, work for the curfew issues and a couple other issues. I've been really happy and satisfied in how she's working. So thank you for that. I wanted to quickly note, she had mentioned Measure T funding for fire station things. And I wanted to quickly mention that I've been living in San Jose for over 5 years, working on what could be, there's a new ideas of what can be better accountability with technology for local communities. And with Measure T, it's a really broad set of bond measures to help the city. And part of, a lot of ideas came into it initially, and one of them was to have oversight for all the ideas that were coming in for asphalt, repavement needs, for firehouse replacement. It's handling issues in the Coyote Valley. And so, they wanted to create a public oversight committee to just kind of oversee things. And part of their duties can be what can be good technology practices. And I just wanted to mention that here just as kind of a reference for yourselves, what's possible with Measure T funding. And I also wanted to, public oversight with technology is very important to me. So that's why I mention it. And it's a very interesting, very positive, sustainable future that it has. That's what interests me about it, and it can address and it can ask good questions of ourselves. The one other thing I wanted to offer is I just have my own personal fears. To really quickly add that we're going to have a possibly very serious fire season coming up, and I hope you can make sure to check in with say Santa Cruz County and neighboring counties to be sure our own county and area will be safe. Thanks a lot.
Chair, if I could just address the Measure T and the Citizens Bond Oversight Committee, is that? Thank you, Mr. Bateman, for your comments. I appreciate that. I know you're at all of our meetings, so I appreciate your comments. But regarding Measure T, there is a Citizens Bond Oversight Committee that has been implemented and will be meeting twice a year to review the funding and mechanisms required in the ballot measure that was approved, and to make sure that the funding allocations are meeting the guidelines of the voters in Measure T. I just wanted to share that.
Yeah, thank you. I know that that's its main purpose, and I was hoping that it would be within a few years' time that it would slowly transition into technology oversight. And the oversight committee, it does ask for a lot, and I thank you for explaining that. And I know that's its initial purpose. So I've been asking, if it's possible to possibly create other oversight committee ideas, but we'll leave that for another time. Thanks a lot.
Thank you, Mr. Beekman, for those comments, and for Councilmember Foley for answering those questions. So if there's no other public comments or comments from the trustees for Councilmember Foley, we will go ahead and we're going to actually have to circle back to 4A. There was one item that in the oral update from Prabhu Palani that he wanted to address along with Cheryl Parkman in regards to updating, regards to the CalPERS update.
Yes, Cheryl, if you can, even though I'm not Prabhu, I apologize. Cheryl, if you can actually comment, provide the board an update on where we at on the implementation of the CalPERS defined benefit plan for the investment staff, I would appreciate it. Thank you.
Sure thing. Hi, everybody. Cheryl Parkman, Office of Employee Relations. So I just wanted to give an update that at the June 2nd council meeting, the first reading of the ordinances to amend our municipal code to allow eligible retirement services staff to get out of Tier 3 and into the CalPERS benefit was passed. A second reading will be held on the June 16th meeting, I believe, which is in 2 weeks. There's always a standard 2-week pause between the first and second reading. 30 days after that, the ordinances will take effect. Now, CalPERS has requested that we provide the employees with the new benefit the beginning of a pay period. So the first day that our employees will be able to enter into that benefit will be July 24th of 2020. So we will be in contact with those eligible retirement services staff so that they can sign up for that benefit or do whatever they need to do to ensure that that benefit is implemented on that date. And that is all for that particular update today.
Thank you, Cheryl. Does anybody have any questions for Cheryl?
Mr. Chair, I don't have any questions, but I wanted two things. First and foremost, really thank the board and specifically those board members that have worked tirelessly of the last couple of years to get this over the goal line. It was fourth and goal, but we got it over. So touchdown. So thank you so much for your engagement and your hard work and dedication. And kudos also to the city and Cheryl, who has maneuvered a lot of challenges, issues to the city and also culprits to get this accomplished. And I just could not be happier for our investment staff. Hopefully they can start joining the culprits if I benefit plan on July 24th. So thank you and congratulations to everyone. Thank you.
Yes, and I echo that too. Thank you, Cheryl, for all the work. And I know the Joint Personnel Committee has been working on this for many years, along with, Vince chairing that. So thank you very much and appreciate it. So if there's no other comments, we'll go ahead and move to the next item. We're going to actually take 4C, D, E, and F all together. And I believe Benji is on the line to discuss this.
Yes, thank you.
All right. Hi, Benji.
Hi. So the next 4 items are to state the new contribution rates for police tier 1 and tier 2, fire tier 1 and tier 2. They're for the fiscal year 2021, and they're based on the actuarial valuations from June 30th, 2019. They're for all of them. Most of them increased by less than 0.5%. There was 1 tier or 2 tiers that decreased, but most of them increased by less than 0.5%. So if there are any specific questions, I'll take those now.
Yeah, so all this everything that's on these resolutions are based off of what the board has approved back in December, January, February timeframe when we're doing the actuarial stuff. So if there's any questions, I'll just go down the list real quick. Trustee Lanza?
No, thanks, Benji.
Trustee Lee?
No, thank you, Benji.
Trustee Menon?
No questions, thank you.
Trustee Muyo? That's a no. Trustee Santos?
No.
Trustee Sanzeri?
No questions.
Trustee Votto?
Nope.
And I got no questions. Any public comments? All right, so I will go ahead and entertain actually, I'll make a motion to approve for C, D, E, and F.
Second by Santos.
For approval. Got a second by Santos, Trustee Santos. Roll call vote. Trustee Lanza. Trustee Lee.
Yes.
Trustee Menon.
Aye.
Trustee Muyo. That's an aye for Muyo. Trustee Santos.
Yes.
Trustee Sinceri.
Aye.
Trustee Votto.
Aye.
And myself, Trustee Gardner, aye. Motion passes 8-0. Thank you, Benji.
Thank you.
All right, so we'll go ahead and go to 4G, discussion and action on Cortex Consulting Services Agreement for 2020-2021.
Thank you, Mr. Chair. So this is an agreement that we actually bring forward to you every June for the following fiscal year. I don't think I have to say too much about the services that are provided by Cortex, but suffice to say that I'm asking you, board, for approval on an updated agreement so that Cortex can continue providing the services that they provide to you, board, most of which are governance related, but not all of them. It is the same amount as in prior years, up to $45,000, which, by the way, over the years haven't really gotten to that point. But again, just a recommendation for your board to approve, and I'm happy to entertain any questions that you may have.
All right, thank you, Roberto. Any questions from Trustee Lanza?
Nope, all set.
Trustee Lee?
No, thank you.
Trustee Menon?
No questions, thank you.
Trustee Muyo? Nope, no question for him. Trustee Santos?
No.
Trustee Sanzeri?
No questions.
Trustee Votto?
No.
And I do not have any questions. Any questions or comments from the public? All right, take that as no. I will entertain a motion for approval.
So moved, Santos.
Motion
Second,
moved by
Censeri.
Motion by Santos, second by Censeri. Roll call vote. Trustee Lanza.
Hardy, aye.
Trustee Lee.
Yes.
Trustee Menon.
Aye.
Trustee Muyo. That's a yes for Muyo. Trustee Santos.
Yes.
Trustee Censeri.
Aye.
Trustee Votto.
Aye.
And myself, Trustee Gardner, aye. So that motion passes 8-0. Thank you, Roberto, for that. We're going to switch things really quick. We're going to skip H and go to 4I, discussion action on municipal code changes related to Tier 1 rehire interest costs. I believe we do have Bill Hallmark on the line from Chiron. I do see Jennifer Strembry from Office of Employee Relations, and we've got Roberto here too. Who wants to start the discussion on?
Hi, everyone. If I could start the discussion, that would be great.
Hi, Cheryl.
Hi again. So what I want to do is first provide background to some of the newer trustees and also to refresh everyone's memory on this particular issue. So as some of you may recall, under Measure B, which was the first Pension Reform Act, if somebody was in Tier 1 and they left the city and then subsequently came back to the city, we actually placed them into Tier 2. Now, under Measure F, we made a change so that any of our employees that came back would be placed back into Tier 1 if they were in Tier 2. Now, if that's not complicated enough, what we also decided to do was to split those costs 50-50 between the city and the employee. And when I say those costs, I mean the cost to place the employee back into Tier 1, because there is a cost associated with that better pension benefit. So why we're here today is because you may recall each employee has an individual balance that they need to pay off. In the police and fire plan, there are 10 employees that each owe their own separate balance and pay that off every pay period at a contribution rate of 1.96%. Now, what also happens is that interest at the board-approved rate of 6.75%, which is the discount rate, is also accruing as these employees are paying down their individual balances. Now, we do have some employees that owe significant amounts of money from their change from Tier 2 to Tier 1. Anywhere from the range of $8,000 to $70,000 were the original amounts. Now, with such a high interest rate of 6.75%, there were several employees who were having a hard time starting to pay down the principal balance of their amounts owed because of this high interest rate. And every year, Chiron does perform an annual report to show each employee how much they've paid down. And the first annual report showed that some employees actually didn't pay down their principal balance at all. So what the city and the bargaining units have agreed to do is to have the city take on paying the interest as of a certain point. So I thought it would be helpful today if I could clarify the intent of that particular point, because I do know that there is some discussion that's been had when we did forward on the municipal code to the board's outside counsel and the board's actuary, Chiron. So the intent that the city has is to pay that amount, that interest amount, as a one-time lump sum. So that means as of a certain date, which would be the effective date of the municipal code, the city would then provide a lump sum to pay off any future costs that would be attributed to the interest payments. Now, I'm hoping that that clears up a little bit of the discussion between the city's council, the actuary, and the city. So I would love to hear from, I know we have Harvey on the call, and I know we also have Bill Hallmark on the call. We're very happy to take any other of their comments and questions on this particular issue. Before we get into those different comments and questions, we did want to address Harvey Lederman's memo that was included in your agenda packets, just on a couple of things that we know that we can address at this point. The first point is that in his memo, there's a number 2, it's titled City Payment Obligation. He is asking if the city's interest payments are going to be permissive or mandatory, and we are making a change in the side letter that we have subsequently provided says the city will be paying it. So these are going to be mandatory payments. So we hope that that satisfies that particular point in Mr. Liederman's memo. At this point, I believe it could be number 1 in his memo, voter approval. We do not consider this to be a benefit enhancement under Measure F in the city charter. So we hope that those 2 issues are now complete, but we're happy to entertain any more comments and questions so that we can clarify any language in the municipal code. So we're happy to speak to that right now. And I should also clarify that we also have Nancy Helu on the call. She's the city's outside counsel, and she is not a Zoom bomber. So I think that that was maybe the issue earlier. So don't worry, your meeting is still secure and safe.
Thank you, Cheryl. Councilman Liederman, do you want to comment at this point?
Well, okay, I can add a few comments. I appreciate that, Cheryl. Make the clarity that the city will, that it's a mandatory obligation. I think what would be really helpful, particularly since we have Bill Hallmark from Chiron and Ann Harper, I think, on the phone as well from Chiron, is if we could actually have an example of somebody who is making one of these reclassified people. It doesn't have to be specific, but even a hypothetical. So we know exactly how this is going to play out. It really does change things. I think neither Bill nor I had heard before that what the city's intent is not to wrap this into the overall unfunded liability of the plan, but to actually make a lump sum payment in advance of the anticipated interest accruing until certain individuals pay it off. But for the board and myself, I certainly would like to hear sort of an example, taking somebody who has an outstanding obligation, has likely 5 more years to pay it off. What is the member going to pay? What is the city going to pay? And if the member leaves before full payoff, who pays what then and when? So just to wrap our heads around exactly how we're supposed to administer this.
Sure. And so I can't speak to the exact individual's amount of interest that they could be paying just because we don't have that particular figure. But the way that we've envisioned it is the city would pay a lump sum for the 10 police and fire employees after the effective date of the ordinance. And so that would cover that payment. So let's say after that effective date, somebody decides to terminate their employment with the city. Under the current municipal code, an employee has 60 days to pay their remaining balance as determined by the city's actuary. So that remaining balance would be any of the unfunded liability and the prior accrued interest up to the effective date of the municipal code. And so that would be the amount that the actuary would calculate, and we would provide to that employee to pay within 60 days. Now, if an employee does not pay that within 60 days, then their pension benefit is prorated at the time of their actual retirement based on actuarial factors determined by the actuary when that person does have their service retirement or service or disability retirement. So I know that that was a complicated answer, and I think Jennifer maybe wants to chime in.
Yeah, I just wanted to clarify that this is already currently in place and is working, and the employee's been paying payments and the board has been administering it. So we're actually not asking you to change anything related to that, just the interest part of it. So already in the municipal code is what happens if they leave before paying and all that sort of stuff. You've already approved all that. So we're just making this minor change to already approved and what Retirement Services is already administering.
May I ask also, I guess from Bill Hallmark, how will the city know what the lump sum payoff amount should be of the anticipated future interest on the unpaid amount going forward? And is it calculated on the unpaid amount or the original amount that was calculated back in 2017 as the increased liability cost?
So we would need to work out the details of the calculation, but what I would anticipate is we would take the balances that are owed and the projected schedule of payments made and calculate what the interest charges would be during that time period if all of our assumptions are met. And so then we could calculate the present value of that amount. And we did provide the city an estimate of those amounts, but they are, as you know, they are the anticipated interest. The actual interest on the liability would depend on how quickly someone pays, which is, we've set the payment rate at 1.96% of pay. And so the amount they pay is going to vary with their pay increases and whether or not they terminate employment. The interest charges also, we would be calculating at 6.75%. And obviously the actual interest charges would change if the board changed the discount rate in the future.
So is it anticipated there'll be some true up ultimately at retirement as to whether the city is overpaid or underpaid?
So as a part of our normal actuarial process, any differences would just roll into our gain or loss and would be charged to the city.
Okay. Okay, I just wanted the board to understand how that was going to happen. So essentially, the city and the board will be looking, staff will be looking to Chiron to calculate who's to pay what amount each year. Is that about it?
So the current contribution rates for both federated and police and fire are these mandatory rates of 3% and 1.96. This would not be, the lump sum would not be on a yearly basis, but any, as we just coined it, true up would just be through the normal process of actuarial evaluations. And so we would provide this as a one-time payment, and then any other additional gains or losses would be as calculated in the valuation, like our other gains and losses.
Got it.
And so based on this particular conversation, there may be some slight modifications we need to make to the ordinance. And so what we would like to propose today is that we provide any sort of updated language of the ordinances to Mr. Lederman and to Chiron so that they can provide further comment. But in the interest of time, because these employees are continuing to pay this cost, we would like the board to provide direction to Harvey and to Bill that they can take this conversation offline and then have the authority to, provide any other further comments that are needed. We are trying to make sure that we do this quickly. And as everyone knows, there is a hiatus of all meetings in July. We'd like to take this to our June 23rd council meeting. So we would like to work with your council and Bill to make sure that that does happen.
All right, thank you, Cheryl, for spelling that out for us of what you're looking for, and also thank you, Council Lederman, for providing your input. Is there any? Let me go down the list to see if there's any comments from any of the trustees. Trustee Lanza.
No, God bless you, Cheryl. I actually understood that.
Trustee Lee.
No.
Very much, Cheryl.
Trustee Menon,
No questions. Thank you, Cheryl.
Trustee Muyo. That is a no from him. Trustee Santos. Trustee Censeri.
Cheryl, thank you for the clear explanation. And Harvey, thank you for raising the subtleties in these documents that we might easily overlook. It's really helpful for us. My suggestion to the board would be to allow Harvey to work on this memo. And in the event that he were to find areas of concern, to come back to our board chair and raise those concerns. If not, then we would be comfortable with that. I'm just trying to figure out a way to move this forward as Cheryl requested.
No, I think what you laid out makes complete sense. Is that a motion you're making?
Yes.
Second that, Votto.
Votto will second that.
Mr. Chair, can I ask the maker of the motion? I think Trustee Sanseri mentioned the chair. Can he also include the CEO? Because I'm going to have to work with the city on whatever needs to happen. So I was just wondering. Or was it understood that the CEO was going to be involved in that process?
By no means do I mean to exclude you, Roberto. I'm sorry. So let me amend my motion so that Harvey would inform both you and the board chair in the event that he was uncomfortable with the language.
Thank you, Trustee.
We could, if I may, Mr. Chairman, we could actually do this by direction to staff, council, and actuary, and not need a formal motion.
Okay. So we'll go ahead and do that before we get complete that process. I just want to make sure that Trustee Votto has an opportunity to say anything if he wants to speak up.
No, I just want to thank the city for carrying the water on this. I think this was definitely the right thing to do.
Just a question, and I defer to council for your board, obviously, Harvey Littleman, but Cheryl, were you looking, or did you, in addition to making sure that we can get you the information you need to bring this forward to city council this month, were you looking for the board's approval on something here, or that's not really necessary?
Based on the municipal code section that relates to the board's providing comment, we are just seeking comments for clarification on the ordinance and to make sure that the logistics are going to work for the administration of the system. So that's why the direction works for us, that we can work directly with both council and Chiron.
Thank you. That's exactly what I was getting at. So thank you. Direction is good enough. Appreciate it.
All right, perfect. That sounds great then. So we don't need a formal vote approval here. It sounds like Cheryl, you're clear on the direction that was given through Vince's comments.
Yes, that's correct. Thank you to the board for providing us with that direction.
Okay, and it seems like we got full support from the comments I heard from trustees. So I will, we'll look forward to hearing back and you working with everybody to get this completed. Thank you.
Thanks to everyone very much.
All right, so we will go ahead and jump back to 4H now. Discussion action on annual performance evaluation policy and performance metrics from CIO positions. I think we have Tom on, right?
Yes, you do. Can you hear me?
Yes, we can. How you doing, Tom?
Great, great. How's everybody?
Doing well. Thanks for being here.
Oh, thank you. And before I begin, I want to thank you for renewing our contract again this year. It's always a pleasure and an honor to work with this board, and we really appreciate your support. And we're looking forward to the coming year. Roberto, would you like me to just jump in, or?
Please do jump in, Tom. You do a very good job providing some background, so I think you can do that. Go ahead. Thank you.
Okay, I'm going to share my screen. Let's see. Give me 1 second. Okay, great. Well, let me, just by way of background, what we want to accomplish today, we have two objectives. Primary objective is to approve both the CEO performance evaluation policy and the CIO performance evaluation policy. The CEO performance evaluation policy would replace your existing policy. There is no current evaluation policy for the CIO, so that would be a brand new policy. The second objective, I'd like to take a bit of time to provide the board with some sense of what to expect in the future by way of process when these evaluations actually take place a year from now and then annually thereafter. So I'd like to review what the process would look like, the types of reports the board would get, the level of effort that would be involved by staff and the board to carry out this process. Throughout the process so far, there's been a perception that it could be very onerous, but hopefully by the end of this presentation, I will put you at ease that it's not going to be as onerous as it might first appear. At least over the first few annual iterations of this evaluation, myself and the JPC and staff, I think we all agreed that we expect the process is going to be tweaked and improved for the first few years with various details being ironed out so that hopefully by year 3 or so, the process will be pretty well defined and pretty refined. But in the first few years, there will be some growing pains we expect. But a little bit of background on how we got here. Some time ago, the grand jury issued a report, and among its recommendations was for the board, both boards, to develop performance evaluation metrics for both the CEO and the CIO. And I think the boards were already contemplating that, but I think the grand jury report sort of pushed that a little bit. The board assigned to the JPC the responsibility or the task of developing those metrics and reporting back to the board so that the board in turn could report back to the grand jury. The JPC realized early on that it would make sense to also look at the evaluation process, not simply the metrics, and confirm the roles, the relative roles of the CEO and the CIO, because all those things were intertwined. So this process has not only dealt with the metrics, but it's updated, reviewed the evaluation processes and the roles for each. The JPC has met, I'd say 3, 4, maybe even 5 times on this process. The CEO and the CIO have both had an opportunity to weigh in on the process and the criteria and the metrics throughout. The investment consultants have commented on the investment metrics, and they were quite comfortable with the direction. Harvey has reviewed the policies and provided some really helpful feedback, which was incorporated. And just last month at the last meeting, the Fed board has approved the 2 policies that you have before you with minor edits, and I've redlined those edits so that you all could see what changes the Fed board approved in the process. Ideally, we're hoping that both boards will approve identical policies that'll just make it easier to administer in the future. In theory, you could deviate somewhat, I think, by way of process, but we're hoping to get identical policies. Of course, you're free to do what you like. The policies do address mechanisms for reconciling differences that might occur in terms of weights and evaluations, but we'll come to that later. I do want to circle back and address that concern about the perception that this is a very onerous process. That's really been the only concern, I think, that was raised through the JPC meetings and as well at the Fed meeting last week or so. And that's the perception that the process seems to be very comprehensive, perhaps too comprehensive, and potentially onerous for the CEO, CIO, and the boards to implement. I can appreciate why board members have raised that concern. You have before you a lot of documents. Some of the reports appear to be very long. It appears to be a very involved process, but I want to assure you that I'm confident that when we actually implement it, it won't be nearly as difficult as it might seem. Roberto, Prabhu, and Barbara have reviewed it. They seem comfortable with the amount of effort that's going to be required. Harvey, I don't want to speak for him, but at the Fed meeting, he indicated it's a reasonable and prudent process from a fiduciary standpoint. He can speak to that at any point in this presentation. My experience suggests that it's also, I think, a reasonable and prudent process. And I think it's going to be effective not only from a fiduciary standpoint, but from just a good business management perspective. A couple of last points. I want to point out that while it might look like the evaluation process involves a lot of information and data, very little, if any, of that information and data is new. What I mean by that is that ORS already collects all of the data, or just about all of the data, that's being contemplated for use in the evaluation process, and already reports most of that data to the board on a routine basis. What this evaluation process calls for is just that at the end of the year, all that data will be pulled together once again to help remind the board of what occurred during the year and help the board inform the evaluation process. So it's really just taking data that already exists and packaging it, summarizing it at the end of the year for purposes of the evaluation process. And lastly, you might have noticed that the sample report contains some calculations for evaluating member service quality. Those are just samples or hypothetical approaches. I think they're reasonable, but the JPC hasn't nailed those down yet. It's really just for illustration purposes. And I don't expect that those formulas would actually appear in the ultimate report that the board gets each year in the course of that process. I expect those to be nailed down in the procedures, which we'll talk about as well. So with all that as background, I'd like to now turn to the actual documents. But before I do that, any questions on any of this background information? Okay, good. Then what I'll do is you have, I think, 6 documents, the memo, 6 or 7, a memo, several policies, a worksheet, a sample report. And I'm just going to walk you through those. Let's begin with the memo. The only thing I want to point out in the memo is in the second last paragraph, just to remind you that what you have before you are the policies. And over the coming months, there's a lot of detail that has to be agreed upon. Those are going to be set out in procedures, which I'm suggesting in the policy that the JPC would have the authority to approve. And those procedures would include things like the formulas and the calculation methods and all the details around how surveys would be conducted, et cetera. Detail that I don't think needs to be in the policy. I don't think the board wants to or needs to get into that level of detail at the policy level. The procedures will certainly be made available to the board, but that was what we contemplated. So that is work to be done over the next few months in terms of details. With that, let's turn to the CEO performance evaluation policy, which is item 2. I think the best way to review this document is to start from the end of the document with the diagram. Can you all see that? I think what I try to do is capture what looks like a very complicated process when you write it out in narrative form. I think it looks much simpler when you put it in a diagram. What this says is that all these boxes on the right-hand side, this represents all the information that's going to inform the evaluation process. And it's gathered on a routine basis from an operational standpoint, in most cases, throughout the year. Some of the information will be calculated at the end of the year for purposes of this evaluation, such as the survey that the board members would complete about the CEO. But all of this other stuff is just calculated, is developed throughout the year. It comes from staff reports, it comes from quarterly investment performance reports, the actuarial evaluation, the audit report, et cetera. So very little of this is brand new information. But at the end of the period, when it's time to do the CEO evaluation, the CEO would be responsible for collecting, gathering, pulling together all of this information, including the CEO's self-evaluation, which he would complete at the end of the year, and compiling a preliminary report, CEO performance report. That report would then be provided, would go from the CEO to the designees, which are 2 members of the JPC. They would be the chairs of each board. The designees would review the CEO's preliminary report, make sure they're comfortable with it, make sure it seems reasonable. They can change it if they wish, modify it, and then they would submit that report to the full board for a closed session discussion. So that process would begin shortly after the end of the fiscal year, June, and sometime between July and September, the board would have a closed session meeting facilitated by the designees. About at least 7 days prior to the meeting, the board members would receive a copy of that preliminary report. They would also get a worksheet, which we'll review shortly. The purpose of that worksheet is really just a tool to help board members mentally collect their thoughts and prepare for the closed session meeting, take notes, write ideas, etc. Everybody would come to the closed session meeting with the report, hopefully with their completed worksheet, ready to have a robust discussion facilitated by the designees, which again are the 2 chairs of the boards. And this, I believe, you already do as part of your current process. After that closed session meeting, the designees would update the report to reflect any additional information, feedback, etc., that the board provided at the closed session. They would then review that report with the CEO. They could make further changes potentially, and it ultimately would go back to the board for final approval, which would probably happen sometime between September and November. Hopefully this process will happen as quickly as possible after the year end, after June 30th. What's not shown here is that the CEO would have an opportunity to comment on the process or the report to the board if he so wishes. And what also is not shown in this diagram is that the process does contemplate a mid-year evaluation. So halfway through the year, the 2 designees would sit down with the CEO and do sort of an informal mini review to keep things on track. But that's basically the process. Looks complicated, but just simply a lot of data gathering goes into a preliminary report, designees review it, closed session, designees finalize the report, review it with the CEO, and the board ultimately approves the report. Any questions on this diagram or overall process? Okay.
Oh, yeah, go ahead. If there's no other questions, yeah, you go ahead, proceed.
Okay, so let me just quickly run through some of the key points of the policy. I think it's self-explanatory. I think that an important thing to understand is right here, paragraph 4. The basic framework for doing this evaluation or for organizing the metrics is along 2 lines. One would be what we call outcomes, measurable performance outcomes, simply outcomes for short. And secondly, how well the CEO manages the means or the methods for achieving the outcomes. So the performance outcomes are the tangible outcomes that the organization produces and represents performance. The methods we'll talk about shortly. The outcomes hopefully are very objective, very measurable, hopefully not subject to a lot of debate. It should be fairly clear. The methods, the approaches the CEO uses are probably going to be more subjective, a little more abstract, and I could see how there might be more differences of opinion among board members. It's important, both outcomes and methods are equally important, but they're simply different. We want to make sure that we're looking at the outcomes, but also keeping tabs on the methods. Because if the board feels that the methods the CEO is using are not appropriate or not working or not effective, eventually they will likely start to affect the outcomes. So by looking at or considering both outcomes and methods, we think it's a more robust approach to the evaluation. And table 1 summarizes what we mean. So for the CEO, and it's going to be slightly different for the CIO, but in the case of the CEO, there are really only 3 outcomes being proposed. One is investment performance. We'll talk about that shortly. Second is the benefit administration cost effectiveness. And third is member service quality. When we come to the CIO, you'll see that there's only going to be one outcome. It's going to be investment performance, again, just given the nature of the job. We expect that the CEO, in the case of the CEO, investment performance will have a lower or smaller weight than it does for the CIO, just given the nature of their jobs. Under the methods that are being used or monitored, we've identified 5 plus an other category: risk management, HR management, stakeholder relations, operations management, and general leadership management abilities. And an other category which will allow board members to identify other issues that they noted throughout the year. So that's the basic framework. It's important to note that only the outcomes, these 3 items here, are going to be assigned numerical weights in the evaluation process, which would result in some sort of quantitative score. The reason for that is because these are more quantitative, more objective, more measurable. The methods over here, they're not going to be assigned numerical weights. That doesn't make them any less important, but just given the nature of what these are, we didn't want to put weights on them. The board will have plenty of opportunity to review information about these things and discuss these, and it will be factored into the CEO's evaluation. We're simply not putting a weight on it. All of this will be confirmed at the outset of the evaluation period. I think that's important. So the Joint Personnel Committee, in consultation with the CEO, would review and confirm for recommendation to the boards what the metrics are going to be for the outcomes and the methods, and any weights to be assigned to the metrics. That should happen in the April-June time period. So that's sort of the setup to the process. Now, how does the evaluation actually happen? And what you see in red, these are some changes that the Fed board suggested last week at the Fed meeting, or 2 weeks ago. Originally, we suggested that the JPC would designate 2 people to coordinate the process, and that they would typically be the board chairs. The Fed thought it was simply more efficient to make it the board chairs by default, unless the JPC decided otherwise. So we've made a slight change there. That seems like a very reasonable idea. In discussions with the JPC and the Fed agreed, we want to make it clear that it's going to be, from a practical standpoint, the CEO who's going to coordinate the gathering of all the information and preparing the initial preliminary report. And that would begin shortly after July 1 of each year in the process. The reason for that is just probably going to be difficult for the designees as board members to really have the time to run around the organization and gather up the information from staff. So the CEO would facilitate that, coordinate that, prepare the initial draft of the report. And again, that may, optics-wise, that may look a little odd that the CEO is preparing his own performance report. But the reality is that all of the information being included has already been provided to the board. We will have in the procedures mechanisms to ensure independence and objectivity. And ultimately, it's still going to be the designees who approve it, review it, approve it, and submit it to the board. The CEO will prepare a written self-assessment and incorporate that self-assessment into that report, so the board will have the benefit of that. And then within 3 months of the end of the evaluation period, and the evaluation period ends on June 30th, the designees would submit that report to the board, and they would have this closed session meeting. And at a minimum, the facilitation, the discussion should result in some sort of consensus by the board with regard to the methods as to whether or not the board feels the CEO exceeded, met expectations, or needs improvement with regard to the methods. Again, the outcomes should be fairly measurable and quantitative and won't require any further description. I think the rest of the process is fairly clear. You see in paragraph 14 that the CEO would receive a copy of the report once it's approved by the board, and would have the option to address the JPC and or the boards in connection with the evaluation. Here we have paragraph 15, which deals with that mid-year evaluation, which I think is important and a good practice. The designees would meet with the CEO to conduct an informal mid-year review of progress to date, discuss any adjustments and other relevant issues. I think paragraph 17 is important around reconciling, because you have 2 boards and 1 CEO working concurrently in this process. We need a mechanism to reconcile any potential disconnects. And we proposed paragraph 17. If the boards assign different weights to any outcome, method, or metric, or provide conflicting input regarding the performance of the CEO on the methods, the designees may reconcile the differences when developing their recommendations to the boards. So it gives again, there might be slight differences, and those designees could work that out and present a consistent recommendation to both boards. I think paragraphs 18 and 19 are also important around the termination or potential termination of the CEO. The boards may terminate the CEO at any time if they deem the CEO's performance to be unacceptable in any way, regardless of how the CEO performed in connection with the metrics and the weights assigned to such metrics. Again, things may have come up during the year which weren't contemplated or which weren't factored into the metrics or the process, and the board has to be able to, if they feel that something is just unacceptable, they need to be able to act. Paragraph 19, in the event one board wishes to terminate the CEO and the other board does not, the board shall schedule a joint meeting of the boards in closed session at the earliest opportunity to resolve the disagreement. Termination of the CEO shall require the approval of both boards. That's a requirement under the city charter, because you both have the authority to hire, jointly the authority to hire and terminate the CEO. And again, this paragraph 20 is what provides the JPC with the authority to approve procedures that would lay out all the details necessary to implement this process. I think those are all the key points I wanted to cover. So that's the proposed policy. If the board is comfortable with that, it would replace the current CEO performance evaluation policy, which is included in the package as a reference. Let me take just a minute to review the CIO performance evaluation policy, because it's virtually identical. I just want to point out the one or two differences. The first difference is in regard to table 1. Whereas the CEO had 3 outcomes to be measured against, investment performance, benefit administration cost effectiveness, and member service quality, the CIO only has 1 performance outcome, and that's investment performance. Under the method section, both the CEO and the CIO have identical metrics. The data would be a little bit different because they're different individuals, but the basic metrics would be the same. The other difference for the CIO evaluation relates to paragraph 13. Which addresses the closed session. Because from an administrative point of view, and an organizational point of view, the CIO reports to the CEO. The CIO reports to the CEO. The CEO shall participate in a portion of the above closed session to deliberate with the boards and share the CEO's perspective on the CIO's performance. Part of the closed session, however, shall be held without the CEO present. So this is another difference between the CEO evaluation process and the CIO process. So that is really it. These diagrams, I believe, are identical. For both policies. So before I proceed, let me open it up to any questions around the proposed policies for both the CEO and the CIO.
All right, Drew Lanza, do you have any comments so far? Questions?
No, I'll have another chance to make comments, right, Andrew?
Well, yeah, you will.
Okay, no, nothing right.
Okay, Howard Lee?
Nothing right now, thank you.
Ezra Menon?
None right now, thank you.
Trustee Muyo? That's a none there. Santos?
Yeah, question, Mr. Chair, and I may have missed it. When it comes to, let's just say we don't agree with the CEO and we want to replace it, does it take 5 out of the 9 or does it take more votes to dismiss a CEO? Because in some cases when we had a vote, we have to do like 2/3 or whatever. So in this case, is it just the majority of the vote of the members of the board?
I would have to, Tom, do you know off the top of your head? 'Cause I know you were just covering part of that in regards to getting two boards approval.
My recollection, I don't believe there's any supermajority vote requirement in any of the policies that I'm aware of for terminating the CEO or the CIO. My understanding is you would need a simple majority of both boards.
Okay, thank you.
Either position.
Yeah, that's right, Tom. And the thinking behind that, Dick, was if we did a supermajority, then one of the boards could essentially veto the firing of the CEO. And so that's why we made a simple majority, as Tom says, but of both boards, which is kind of in its own sort of way like a supermajority.
I got you. Thank you.
Vince, do you have any questions so far?
So far, no questions. I'll make some comments at the end. But Tom, as you're going through this, can you also give the board a sense of what's going to be expected of them as a trustee, not necessarily a board chair who would be doing the CEO evaluation, but when they're going to step into a closed session meeting, the kind of work that they would have to do in advance of that meeting?
Absolutely. I think that the next document will probably help get a better understanding of that.
All right. Vado, you have any questions or comments so far?
No.
Roberto or Prabhu, you guys have any comments?
No, at this point, no.
Okay.
I'm here. Thank you.
Okay. All right. Why don't you go ahead and continue, Tom?
Okay. I think the next document kind of leads into what Trustee Sanzeri was raising. But before I go on, let me touch on that further. In this process, if you're not on the JPC and you're not, in particular, if you're not a designee, the workload for a regular board member in this process would really consist of this step here, where every board member would complete a survey at the end of the year, providing commentary or input on the CEO's general management skills. And that's a 3 or 4 page survey, 40 or 50 questions, probably would require hopefully at least 15 or 20 minutes of thoughtful completion at least. And then at some point, every board member, about a week before the closed session, you're going to get this preliminary report. I've prepared a sample report. We're going to look at it shortly. And the body of the report, if you exclude the sort of introduction and background, is really about 12 pages long. So you'd have to review that 12-page report. That report would be accompanied by another document which has a bunch of background documents like the financial audit, survey results, risk reports, etc. That's for reference material. It's probably going to be, could easily be 60, 70 to 100 pages potentially. But that's just available if a board member wants to dig into more of the background information to help them come to conclusions or better understand the report. I doubt that any board member would necessarily read all of it because, for example, the financial audit report, you would have already read that report earlier in the year. You might want to just skim through it to refresh your memory. The other thing you would do is receive I think a 4-page worksheet, which is simply a tool you can use to help you gather your thoughts as you review the preliminary report. And that might take, I don't know, half an hour or so to complete, an hour, I would think, at the very most, and we're going to walk you through that next. So those would be the efforts. And of course, I suspect this closed session meeting would probably be about 2 hours in length. I think that's about what you've been spending in closed session in the past to evaluate the CEO's performance and the CIO performance. So that's sort of at a high level, the amount of effort that individual board members who are not designees of the JPC would have to put in. And then at the very end, you're going to receive the final report for approval. I don't think that would take a lot of effort. But let me give you an idea of what that worksheet would look like. That's the next document. item 5. This is a tool designed to help, let me zoom this in a little bit. This focuses on the management methods, the qualitative elements of the evaluation. It contains 6 sections, and it's really just designed to help board members take notes on each of these 6 topic areas, so that when they arrive at and as they review the preliminary performance report and the background documents, so that when they arrive at the closed session, they come prepared to have a robust discussion. And they would be invited to bring this worksheet with them, because I think that would help the quality of the meeting. And it just walks you through each of the 6 or 5 qualitative metrics or management methods. And let's take human resource management, item B. And it would tell you that in the performance report, you will have received information about employee turnover rates and attrition rates, vacancies and hires, any reported violations of the code of conduct, the results of the employee climate survey results, and the CEO's self-assessment of his performance in the area of HR management. That's all the information in the preliminary report. Based on all that, board members are asked to indicate, does the CEO's performance with regard to HR management exceed or meet my expectations, or does it need improvement? And there's space for any comments or suggestions that I would like to share with the CEO and or the board, which I can raise at the closed session meeting. We put in some space that if there are other factors and information that influenced your assessment of the CEO when it comes to HR management, and were not included in the preliminary report, and you think they're relevant because they influenced your thinking, then you may want to list them here, and you could share that at the closed session meeting as well. And we also included some space because inevitably, as you're going through this process, you'll probably realize that there's some information you would have liked to have had, or maybe you would like to see different metrics. This is some space to include some notes on how the process or the metrics or the data could be improved for next year. And it's the exact same layout for each of the 5 management methods that make up the qualitative part of the evaluation. I should point out that stakeholder relations, the data for that comes from interviews with stakeholders, but the JPC decided that those interviews they can't happen every year. That would be overkill, and it would be an imposition on the stakeholders, but every 2 or 3 years. So in most years, there won't be any information to review on stakeholder relations. It's not to say that the board members may not be able to have a discussion, but there won't be any data per se, formal data. So that's the worksheet. At the end, there's space for any other metrics and factors, any other accomplishments, challenges, or issues that occurred during the past year that you believe should be factored into the evaluation, but they maybe weren't contemplated at the beginning of the year, positive or negative. And lastly, some space for any other notes. So again, this is just a worksheet board members would have at their disposal, hopefully use as they're reviewing the preliminary report. Any questions on that? Okay, so with that sample worksheet would accompany the preliminary performance evaluation report that the board members will receive a week before the closed session meeting. What I've done to give you some idea, and again, this is very preliminary, the JPC has not dug into this in any detail or approved it. And I think a lot of the formulas and calculations you see in this performance, I included them just for transparency to give you an idea of what I'm thinking, but they would ultimately end up in the procedures, therefore making this report much more streamlined. So the first few pages of the sample report, I would expect just give a bit of background, review the framework, review what those organizational outcomes are that were approved by the board. In the case of the CEO, there's 3 of them: investments, cost effectiveness, member service. The weights, I have made up these weights. I just came up with some numbers that I thought were reasonable, but these have not been reviewed or approved by the JPC. It's just for illustration purposes. I assigned 20% to investment performance, 10% to cost effectiveness, 35% to delivery of benefits, and 35% to member satisfaction. And then you can see the subweights. They're all adding up to 100%. Again, this is all just background. These, again, for background, are those management methods, the qualitative factors. There are no weights assigned here. These are the sorts of metrics that apply to each of these methods. Again, all essentially taken from the policy. And then you come to the actual report. Again, this is fictitious. I simply made it up. But on one page, you should be able to summarize the results of the performance outcomes. The investment performance, where the metric is net value added relative to the objective over a rolling 3-year period, which had a 20% weight, again, is fictitious, but the CEO in this particular year, and I'm looking out 3 years, 2023, as if we're 3 years ahead, and we have 3-year numbers. The CEO scored 11.4, which represents 50% of the net value added objective, and you can go to page 5 for all the details. Cost effectiveness at a weight of 10%. CEO scored 7 out of 10, and you can go to page 6. It'll explain how we arrived at that. Benefit delivery had a weight of 35. The CEO scored 26.5 approximately. And you can go to page 7 to see the details, how we arrived at that number. Member satisfaction, which is a result of all the various surveys that are taken during the year, had a weight of 35. CEO scored 23, and you can go to page 9 for all the details. So on these quantitative organizational outcomes, this fictitious evaluation in 2023 yielded a score of 60, approximately 68 out of 100. Not a great year, but again, it's all made up. And then we go section by section and provide the details of how we arrived at those quantitative scores. And I won't go through all the detail because again, this will be all approved, put into the procedures over the next few months, and the JPC will spend a lot more time sort of finalizing this and getting comfortable with it, and to be reviewed with the board at that point. But this summarizes how we arrive at an investment performance calculation. It's going to be the same calculation you use for the CIO. This one page summarizes how we calculated a score for benefit administration cost effectiveness. You simply come up with a table with scores. This is arbitrary. The JPC hasn't looked at it. And we arrive based on the table with a score of 7. And then we have an awful lot of information to translate benefit delivery information and member satisfaction survey scores into overall evaluation numbers. And I won't, unless you want me to, I won't go through all this data, because again, the JPC didn't have time to go through it just yet. And then you come to part 3. You would have completed the quantitative performance outcomes. The rest of the report deals with those management methods, the qualitative information. And it simply summarizes various information pertaining to the metrics dealing with risk management, the financial audit results, the quality of the internal audit plan, internal audit results, compliance, and management's response. And I've made up, this is all hypothetical, how the CEO did over the course of the year. Again, this is looking out to 2023 in each of these areas. So again, all fictitious. In the case of HR, again, I made up data. The metrics are employee turnover, vacancies, code of conduct violations, climate survey results, and I made up some information that there were 3 instances of employee turnover during the year, 2 retired, 1 moved to another state. There were some vacancies. Some have been filled, some haven't. Here are the reasons. There was 1 violation of the code of conduct. It was presented to the board. you would have been aware of that if it had actually happened, but this is just reminding you. And then a staff climate survey was administered in June. And this is a quick summary of the results, with the full results being in the separate document. So this report goes factor by factor, or management method by method, and simply provides a summary of what happened during the year, with references to background documents if the board member wishes to get further, to dig deeper into the background information. And it's about 17 pages long. But as I said, the first 3 or 4, 5 pages, I believe, are simply background. The actual report itself, in this case, is about a dozen pages. And let me just quickly, I won't go through it, but this is all those background documents. I believe this is about 72 pages. But again, board members don't necessarily need to read all of it, or they can pick and choose whatever they'd like to dig into, because they will have seen just about all of this information earlier in the year. This is just pulling it all together one more time at the end of the year to remind board members for purposes of the evaluation. And it's organized, as you can see, to match up with those management methods. And I'm happy to go through if anybody wants to, but these are just a mix of fictitious data or actual reports that I obtained from staff and incorporated them just to make it look realistic. So I know that's a lot of information. Hopefully, again, my goal has been to put you at ease that it's when you actually roll it out, it won't require a lot of board member time. It won't require a lot of staff time, because staff is already gathering and collecting the vast majority of this information throughout the course of the year. And it won't require a lot of individual board member time. What it is designed to do is to make sure that when board members arrive at that closed session meeting, they have all the information at their disposal in one convenient place if they want to have again, a robust discussion on the CEO's performance over the course of the year, rather than trying to simply remember what happened across the various factors 12 months later. And with that, I will open it up to any questions or comments.
Thank you for the thorough presentation, going through all those documents for us. Let's go ahead and go down the list for questions. Trustee Lanza.
So I'll just make a really brief comment. First, Tom, your usual excellent work, and thank you very much to the Joint Personnel Committee. HR stuff is hard in detail, and you really did a good job. So not every trustee has been here. I love, Roberto, that you said sort of fourth and goal to go on the CalPERS thing, and congratulations, Roberto, along with us, for carrying that ball over the goal line. So why is this important, and why is this level of detail important? So just let me pontificate for a minute. So we're in a 20-year football game. This football game started 15 years ago. The first quarter was San Jose saying, "Yeah, I think we ought to do pension." And the game enters the half, right at the end of the half, 10 years ago, with independent trustees being brought on for the first time. And Vince and I are the remaining 2 independent trustees, the 5 that were brought on at that time. Then we go into halftime. And the second half opens with Measure G. And this is all about us now having been independent directors, 4 or 5 years, and saying, boy, we need a little more independence. And Roberto, I think, talked about sort of the close of the third quarter, now 15 years later, from that initial thought of pension reform with, okay, Drew, I think we've kind of reached this point now, we're sort of stable, and thank you for giving us on CalPERS. And now Tom has opened up the fourth quarter. And the game will be over in 4 or 5 years based on 2 final remaining drives. And you all know this. The 2 drives are independence over our own budget. And now then, of course, as Tom and the JPC have done, independence over our own personnel. We're not quite there yet. And I think that's understandable. Measure G was hard fought, and the city said, okay. But before you go fully independent, show us that you can crawl and then walk and then run. So we have input, and we have actually control over your budget, and we still have control over your top executives, Roberto and Prabhu. And so within that context, the reason why what Tom and JPC have done and it's complicated and it's involved. Oh, I agree with you, Tom. When we actually implement it, it'll be simple, right? Is to show the city, these last drives are to show the city that we can be trusted with the budget and we can be trusted managing people. I believe we'll get there in 5 years, 4 years, 3 years. I believe there will be another measure on the ballot. It will come in 3 or 4 years, and it will say, we as the city trust now these boards. You may hire and fire Roberto and Prabhu without our approval, and you may do a budget without our approval. So Tom, I thank you. I thank the JPC. The way we will get there is by being thorough and thoughtful and professional. And as always, Tom, this is a thorough, thoughtful, and professional job. Thanks for letting me pontificate, Andrew.
No problem, Drew. Thank you for the comments. Trustee Lee.
Yeah, well, yeah, thank you, Trustee Lanza, for that, and thank you, Tom, for the in-depth description. Just two questions. One, with respect to the changes in the drafts versus the prior methods of evaluation, what would you say, Tom, were like the one or two big changes that were made? My sense is part of it's the metrics. And the second question is, given where we are in the cycle right now, are we due to receive or know what the metrics are from the JPC pretty soon before the evaluation starts?
Yes, thank you for that question. You're correct. I think that the major differences between the current CEO evaluation policy and what's being proposed really does boil down to the metrics. The new policy has fleshed out the metrics in much greater detail, but the basic process is very similar. You'll see if you review it. There aren't any major deviations, I don't believe. In terms of how soon, I think if the board approves pardon me one second. If the board approves the policy, the metrics are embedded in the policies. What we would simply need to do is have another meeting with the JPC and agree on the weights. Just how much weight do they want to apply to the different metrics? And I think at least a general understanding of some of the key details of how we're going to measure these things in the course of the year. And I think that could be done with one more JPC meeting, and then it could come back to the board at a minimum with the weights. I think if the board approves the weights sometime soon, and I think this first year is going to be a bit of a trial run. So I think if we get this in place a little bit after July 1, I think it's reasonable, because it's going to take a while to develop all the metrics. We don't have 3-year investment performance numbers, for instance. We won't have those for 3 years, of course. So I hope that answers your question. I think we could get back to the board after one more JPC meeting with weights and at least the key or the critical details around the implementation during the year.
Okay, great. Thank you.
Thanks, Trustee Lee. Trustee Menon.
Yeah, thank you, Tom, for the presentation. So in terms of the information gathering, I think you said, a lot of the information people have already seen, and the investment staff will pull it together. But I guess if the JPC wants something specific, they can request that, right?
Oh, absolutely. I think if hopefully we can define that early in the process, so that during the course of the year we are gathering whatever information it is that the board or the JPC feels is necessary to effectively evaluate the CEO at the end of the year. But this is still very flexible. We can make modifications as we go.
Thank you.
Oh, you're welcome.
Trustee Muyo.
Can you hear me now?
Yes, we can.
There is a guy. No, I don't have any questions. Thank you very much, Tom. Really appreciate it.
Oh, you're welcome.
Thanks, Nick. Trustee Santos.
Yes, Drew said it real well. And this is a document that shows how we manage our selection. So this is excellent. Thank you.
You're welcome.
Trustee Sanseri.
Thanks, Andrew. And Drew, thanks for your comments. I mean, it does help put things in perspective for me. I have had some concerns that I feel a bit like a rookie walking into an NFL camp, having to learn this playbook that seems extremely overwhelming. And I feel like we've got about a 2-year period of time to see how this is going to work for us. Until we actually run through the motions for a couple years, it's going to be difficult to know how effective this is for us. If you think about the process that we've gone through before, and several of you have been board chairs. Nick, you've been a board chair. Drew, you've been a board chair. So there's at least 3 or 4 of us that have gone through these CEO reviews under the old process compared to this new process. And I think this is light years ahead of what we're doing. I think this meets what the grand jury and the city auditor is looking for. I have some concerns and reservations that it could be a little bit of overkill. And I think that's where this 2-year trial period will give us some insights. The one important area for me is that one of the members of the Joint Personnel Committee asked that the CEO and CIO do a draft evaluation first to kind of kick this off. And in one sense, that eases the burden on the designee or in this case, the board chair or the investment committee chair that would be writing the review. At the same time, it's a little odd having a CEO or a CIO start off giving their own review before we've even had a chance to do our own review. Typically, the CEO and CIO give their work plan, they give their list of accomplishments, but now to start off giving their own self-evaluation just seemed a little odd to me. So I think we're gonna have to go through again an evaluation process and see how that works. But most importantly is that requesting that of our CIO is very sensitive to me from a time perspective. If we go through a cycle and we find out that it was very time consuming for Prabhu to pull together his self-evaluation, I'm not going to be a fan of this. His priority and his focus should be on managing the plan, not doing administrative work. And the amount of documents here are voluminous. And Tom assures us that it could be a pretty smooth process. It's not as overwhelming as it looks. A lot of this data is already available to us. So I'm going to trust the process until we go through it first. But I just want to make that one caveat that I think we need to be very mindful of that and not burden our CIO with something that could potentially be so administrative. On the plus side, one of the things, in addition to the items that Drew pointed out that we would really like to see come out of this is eventually to develop an incentive plan for our investment team. And this goes a long way of starting to put meat on the bone in developing the infrastructure for how we're going to evaluate personnel, so that way we can determine whether they're hitting metrics or not, and being able to evaluate performance and whether they qualify for potential incentive compensation down the road. So that can take us a long way. I will also end with saying that at one point in time on this board, we did have a trustee that had HR experience. We don't have that now. We don't have anyone on the Joint Personnel Committee that is an expert in human resources. Tom has been fabulous as our consultant in drafting governance policies, but we have not reviewed this with a human resource professional. So that's something that we do also need to be mindful of as we go through this process in the next couple of years. So I applaud the depth of the work that Tom has done. The committee has spent a lot of time on this. I'm eager to go through a cycle or two in tackling this, but the caveat is that we need to I think treat this as a bit of a trial, and we may have to go back and rework it after a couple of iterations. That's what I wanted to share, Andrew.
Thanks, Vince. Well said. Trustee Votto.
No, I've got nothing.
All right. Roberto, do you want to chime in? Do you have anything you want to share or questions you have?
Not really, not much. I mean, there has been a lot of discussions, first with Tom directly and then with the JPC, as most of you at the JPC committee know. I have to say that I'm in line with Trustee Sinceri's comments. You know, I always, when the discussion goes, I take notes for myself, and yeah, and Trustee Sinceri didn't see this, but you as a chair know, I responded to a member of the grand jury that was asking for, you know, where were we on this process, and that was one of my points, that this is really an ongoing process, right? Because as we go through it, we're always going to be making modifications and updating the process, which is, I think, is Trustee Sinceri's point. Yeah, so I personally, you know, I kind of look forward to seeing how this process works in the next couple of years, and you know, how we can tweak it for the benefit of not only the boards, so that they can get a good idea on assessing the performance of their executive, but also for the CEO and the CIO, right? So you said this is a joint effort, and so I'm looking forward to it. So that's really all I have. And to Tom, he does a great job putting the information together. I do follow what he's explaining, and I do believe it is not as challenging and time-consuming as maybe expected. But boy, I gotta tell you, for someone that is looking at this for the first time, it is difficult to wrap your head around all the information. So it is scary at the beginning.
Thank you, Roberto. CIO Palani, you have any thoughts to share?
No, Mr. Chairman, thank you.
Okay, Council Leaderman.
Yeah, just a brief comment, and I'll try to stay away from football metaphors. This evaluation process is really the second half of the overall process. The first part of the process is setting goals and performance objectives at the beginning of the year. You can't know how to evaluate and measure someone's performance unless you do that. I should point out, both the CEO and the CIO have employment contracts, and their employment contracts specifically call for, as part of the evaluation process, mutually, the board and them individually, mutually setting goals and performance objectives at the beginning of the year against which they will be measured. So I think those, if Tom, I think, calls it metrics or the outcomes, those are to be established by the board at the beginning of the year. Whether that's delegated to the JPC, I'm not sure if that's the intention, or for the JPC to work up a recommendation and bring it back to the full boards. But the boards need to be on board with the CIO and the CEO at the beginning of the year about what those performance objectives will be, what weightings will be, so that they know how they're being measured to perform against. As I say, you can't know at the end. The board can't know if the individuals meet expectations unless you first set the expectations. So I'd like to make sure that the second half of the evaluation process harmonizes with the beginning of the process, which is setting the goals and expectations and the outcomes that are going to be expected for the forthcoming year. And I'm not sure yet how that's going to be integrated into this, but I want to make sure that we don't forget that that's what we're doing before we're going into the evaluation process at the end of the year. Thank you, Mr. Chairman.
No, that's a great point. I mean, it's only fair for CEO and CIO to know going into the year what they're being held to and what we're evaluating them on. So very great point, and I think that's an emphasis that we definitely need to stress going forward. If there is no other questions, this is an item that we do need to approve, and we'll entertain a motion.
Motion to approve, Santos.
Got a motion?
Could I respond to that one last point?
Absolutely, Tom. Go ahead.
Just to put everybody at ease, Harvey does raise a great point. But both policies, paragraph 8, in both policies, CEO and CIO specify that in the quarter preceding the start of the evaluation period, i.e. sometime between April and June, the JPC, in consultation with the CEO, shall review and confirm for recommendation to the boards all metrics to be used to evaluate outcomes and methods and all the weights. So that's where we intended to make sure that all of the criteria would be established and agreed to at the outset, beginning of the evaluation period, not at the end. It doesn't say that the CEO has to approve. It says in consultation. So if we'd like to change that word to be consistent with the contract, we could certainly do that.
All right. If we're setting, can we explore that a little bit? So you're talking about setting the standards in March, April, sometime in the springtime, and that's going forward for the new fiscal year, right?
That's right.
Okay. No, I think that's something that would probably want to express in the, if we're going through this process to try and detail things out, that's probably something that we probably want to add into it than expressing, when we're going to make that or implement that step in the process. Does anybody else have any comments on that? They want to chime in? All right. Trustee Santos, I know this recommendation was coming forward to add to what your motion. Are you okay with that?
Yeah.
Okay. So we got a motion by Santos. Do we have a second?
Second by Sinceri.
Second by Sinceri. Do we have any public comments? All right, we'll go ahead and go down the list. Roll call vote. Trustee Lanza.
Aye.
Trustee Lee.
Yes.
Trustee Menon.
Aye.
Trustee Muyo.
Aye.
Trustee Santos.
Yes.
Trustee Sinceri.
Aye.
Trustee Votto.
Aye.
And myself, Trustee Gardner. Aye. Motion passed 8-0. Tom, thank you very much.
Thank you, everybody. Enjoy the rest of the meeting.
Thanks. All right.
Thanks, Tom.
On to 5.1 retirement services. We got two retirees, Jeffrey D. Enslin, police officer, police department, effective July 4th, 2020, with 25.30 years of service with reciprocity. Sean San Miguel, fire engineer, fire department, effective July 11th, 2020, with 25.25 years of service.
Motion to approve, Santos.
Motion by Santos. I will second that. Gardner will second it. Roll call vote. Trustee Lanza.
Aye.
Trustee Lee.
Yes.
Trustee Menon.
Aye.
Trustee Muyo. Trustee Santos.
Yes.
Trustee Sinceri.
Aye.
Trustee Votto.
Aye.
And Trustee Gardner. Aye. Does anybody have any comments? Votto, did you know this gentleman?
Yeah, I worked with Jeff a number of times, and I wish him the best of the luck in his retirement.
And I've worked with San Miguel for many years at my current station. Wonderful person, wonderful friend, great firefighter, and best of luck in your retirement. So we'll go to death and survivorships. We do have a few names on our list, unfortunately. Notification of death of Timothy Gallagher, fire engineer, retired August 5th, 1999, died January 23rd, 2020. No survivorship benefits. Notifications of the death of James Lamar, fire captain, retired August 2nd, 1989, died March 26, 2020. No survivorship benefits. Notifications of the death of Donald L. Torgeson, firefighter, retired January 2nd, 1974, died April 11th, 2020. No survivorship benefits. If we can, at this time, take a moment of silence. Thank you. Trustee Santos, do you have opportunity to know any of these gentlemen?
Yes, Mr. Chair. It's a very sad day for me. Tim Gallagher and I came on together in 1968. He was an excellent firefighter and fire engineer and liked by all. And so it's very sad. Captain Lamar, James Lamar, was my captain in the Bureau, and I definitely miss him. Great guy. And Mr. Torgelson, I worked a little bit with, didn't know him well. But it's a very sad day, and the best of their families, and thank you.
Thank you for those kind words and condolences to the family. All right, 7.1, let's go to committee minutes and reports. 7.1, Investment Committee. Trustee Menon.
Yeah, nothing significant. I think the meetings, one was to discuss volatility and change in allocation. The next meeting also was discussing allocation, some of the changes we've done during this downturn. And then the last was regarding the pre-funding from the city.
All right, thank you.
Just a quick note to the board, and I'm sure Andrew feels the same way. Eshfar, thank you. You took a battlefield promotion, and you're doing a great job. We really appreciate your effort.
Thank you, Drew. I appreciate it.
I echo that. Thank you.
Thank you, Andrew.
We do have 4 minutes, separate minutes to receive and file. That's special March 11th, March 11th, 2020, March 24th, 2020, special meeting on April 20th, 2020, and December 17th, 2019, joint minutes. So we'll go ahead and receive and file all of those minutes. 7.2, audit risk. Trustee Votto.
Yeah, I'm going to apologize, Roberto. I had another call start at 1, so I'm literally on 2 Zooms right now. Could you maybe give the update for me?
Sure, I'll do that, Trustee Votto. The way I'm going to suggest we do the update is skipping the any kind of items that are received on file, like the minutes, and just key in on the specific issues that were discussed at the meeting last month. So if we can start with the update on the city auditor's recommendation, nothing really have changed from the prior metrics. In fact, there was a suggestion which I completely support. I just failed, I think, to raise this issue at the agenda review with police and fire, is that going forward, we'll continue presenting the city auditor's recommendation metrics at the audit committee level, unless there is an update on the work that is being performed. So whenever there's a few months that goes about without any updates, it would just go to the audit committee. However, if there's an update on a particular item or two, we'll bring the metrics to the board as a consent item. So next item, if you can go down, Linda. Or whoever is driving the...
You want to go to, is it G you're looking for?
Well, I'm looking for the items after that. So the next one is update on the pension administration system implementation project. Just a quick note, I mean, Barbara is actually in attendance as well for the Zoom meeting. This actually was the final presentation that staff made to the audit committee. The pension administration system project has officially been signed off. So we have completed the project. Of course, we're always looking for improvements or any kind of changes that may be needed. So that will never stop. But as initially intended, including the measure F changes to the benefits have either been implemented or they have been tested already. So just big kudos to the staff. Obviously, Barbara was our lead person managing the project internally, and from the outside, now on the Seagull, the management consultant to help us managing the project was instrumental on getting us to the promised land. And so, as you all know, it took a little longer than anticipated, but it was certainly within budget. In fact, the total cost of the project turned out to be less than what was initially approved in combination for both boards. So that's a big accomplishment. And wow, I mean, 4 or 5 years of a lot of work. So I don't want to just key in on Barbara and our management firm, but also on the rest of the staff, because it meant that for many years, staff at the office at times had to redo or do more than the regular work, especially towards the end of the project, and especially when we ran parallel the former pension administration system V2 and the new one implemented V3. So big kudos to everyone. Congratulations for an excellent job. You know, if you have any specific questions about the memo that is there or the PowerPoint presentation, we are happy to address them. And with that, before we go to the next 2 items, I'm just going to ask Barbara if there's any comments that she may have for your board on this.
No, I don't actually have any additional comments, but happy to say that the project is finished, implemented, and seems to be working really well.
Roberto, let me jump in, because I cannot sing your praises, and Barbara, of course, I've sung your praises so much I'm almost hoarse. I've been involved now in 5 or 6 of these, and these are scary at this level of a huge database conversion. Barbara, this is as good a job as I've ever seen done, and I've seen teams with a lot of money and a lot of time. Barbara, really, really well done. Thank you, Roberto, for letting us sleep well at night.
Thank you for your comments, Trustee Lanza, and really, trust me, thank you to Barbara and the staff for allowing me to sleep well at night. I was always concerned, to be quite honest, and Barbara knows this from the beginning when I was lucky enough to join both of your boards as the CEO, I was always concerned about the resources, right, that we had internally to really work to do this project. But, you know, Barbara promised me that she was going to take care of it, and wow, she did. So again, big kudos to Barbara and the rest of the staff, and of course, Donna, who's also retired, and of course, the work by our management consulting firm that was helping us, you know, through the process. So with that, the next item is the report on service retirement application process and benefits calculation audits. First, let me just say, obviously, all the trustees for the audit committee for police and fire were present at the meeting. Big kudos to everyone for their engagement, and especially Trustee Howard Lee, who was the latest addition to this committee. He not only asked some excellent questions during the audit discussion, but I follow up with him and providing him the framework that you all had a chance to approve, but Trustee Howard Lee was not present, as well as the 5-year audit plan. And the reason I say that is because I got to tell you, many of you know that my background, my first 10 years out of college was internal audit. In fact, I don't know if you all know, but I'm a certified internal auditor, or at least I used to be. I'm not sure that I'm as certified as much anymore, but and this is an area that is close to my heart, and I just thought that the work that was done by our senior auditor, Elaine, on the framework and the 5-year audit plan was just excellent. So I just kind of want to mention that again. I shared that with Trustee Howard Lee, and he has implemented and continue with the process of going through the 5-year implementation plan for the audits. And so what is before you, he made a presentation on the specifically 2 audits that he worked on recently, which were the service retirement application process and the benefits recalculations audits. And just wanted to give you the bottom line of this. Bottom line is that our office have good practices in the administration of the service retirement application process and the benefit calculation. So that's always good to hear. But I wanted to also point out 2 things. Along the findings, and again, you can read his report that is attached. There were 2 things that we promised to work on. Number 1 is, and if it wasn't for this audit, I don't think that I would have really understood the implications. We are trying at the office still to do better on the timing of processing that first retirement check. I think, for what I understand, way back 10 years ago, when we have the downturn in the economy and lost some positions at the office, plus the big increment of retirements, I don't want to say that we laxed, but we realized it was going to be a challenge at the office back then. And so allow for some flexibility on implementing the process to provide that first check as quickly as possible. I still think that we do a reasonable job, but depending on when a member retires, sometimes it may be close to 60 days before they get their first paycheck. So I wasn't happy with that approach. And so we agree as management to look at the process and see where we can actually improve it so that we can decrease the timeline for that first paycheck for the retiree. So that's one. The other one have to do with the COLA calculation method for the tier 2 benefits. And, there were some findings that is requiring us to go back and confirm that the calculation process is correct. The good news is, as you know, there are not that many tier 2 members that are retiring anytime soon. So we have time to make sure that the process is properly implemented. But those were the main 2 issues that we found. So again, if you have any questions in particular to those comments, please do let me know, and I'm happy to address them. If there are no questions, the last one, which is one where we will need your board action, is in the committee recommendation to approve the audit plan by Grant Thornton of our CAFRs of the work to be completed for the year ending June 30th, 2020. I won't go into much details. The information is attached, but they went through a memo and a PowerPoint presentation. As they do every year, is the same presentation. This may be the last audit that they perform for the plans, but again, I will, based on the presentation of the audit committee and the committee recommendation to approve the plan, I will recommend to your board to approve the plan as presented. And obviously, I'm ready to address any questions that you may have. That concludes the comments, Mr. Chair.
All right, thank you, Roberto. So Roberto did cover a lot of items under this section. So be free to speak on any of the items that you guys want to talk about. Trustee Lanza, you have any comments, questions on anything?
No, I don't. Thank
you. Trustee Lee?
No, Roberto, thank you very much for the kind words, and I look forward to continuing the work on the audit committee.
Trustee Menon?
No questions. Thanks for the presentation, Roberto.
Trustee Muyo?
Thank you, Roberto. No questions.
Trustee Santos,
No, thank you.
Trustee Sanzeri,
No questions.
Trustee Votto.
No, but thank you, Roberto. I just had to be on this other call.
No problem. All right, so this last item, item G, we do need to approve. So I would entertain a motion for item G.
So moved. Santos.
Motion by Santos. I didn't hear the, is it Votto I heard?
Second.
Oh, second by Lee.
Second. Yeah, correct.
Okay, second by Lee. Any public comments? All right, roll call. Drew Lanza, how do you vote? Trustee Lee.
Yes.
Trustee Menon.
Aye.
Trustee Muyo.
Aye.
Trustee Santos.
Yes.
Trustee Sanzeri.
Aye.
Trustee Votto.
Aye.
All right. And myself, Trustee Gardner, aye. So that motion passes 8-0. Just we need to go back and I need to capture all the receiving files. So we want to receive all the minutes and documents for 7.2B, C, D, E, and F, and we'll receive and file all of those. Which brings us to governance. Trustee Muyo, any updates?
No update. So we had our last meeting in March. We're scheduled for our next one in 2 weeks. Roberto, please watch for either a phone call or an email from me before that meeting. With that, I've got nothing more.
Will do. Thank you, Trustee Muyo.
Comment, Mr. Chair, do we have any idea what time that's going to be? And I thought we're going to have governance meetings after our normal retirement meetings. Is that going to be the process, Nick, or are we going to change it? Or just adapt when we can?
No, if we do go ahead with the meeting, Trustee Santos, it will be after a regularly scheduled board meeting. I don't remember if it's after the police and fire or federated. Right now it says
it's always been after the police and fire.
So this one says June 18th, so that will be after the federated board meeting in 2 weeks, if we go ahead with one.
Okay, about what time? Is that like after 1 or 2 o'clock or something?
It's hard to say. We don't know the agenda for
Okay.
Fed yet, so as soon as we know, we'll let you know. Thank you.
All right, thank you.
All right, 7.4 Disability Committee, Trustee Santos.
Thank you, Mr. Chair. It looks like we're going to have the next one scheduled for August 10th at 10 o'clock. Either a Zoom or, if we're blessed enough and safe enough, back at our headquarters, but we'll see and wait. See if Drew has anything to add.
Nope, I agree, Dick. Fingers crossed.
All right, thank you.
That's it.
All right, thank you. 7.5 Joint Personnel Committee, Trustee Sanzeri.
Yeah, we pretty much covered it during the agenda earlier on. Thanks for everyone's patience going through all those documents. That's the only item we've been tackling over the course of several meetings. Nothing else to report except the minutes need to be received and filed.
All right, thank you. Yeah, let's go ahead and receive and file the minutes for February 25th, 2020 at 7.5B. Thank you. All right, proposed agenda items for next month. If anybody has it, just speak up. If not, I just have a couple comments that I'll throw in the public comment section. One is Drew, Roberto, Harvey, and we've started having conversations earlier this month about what would our meetings look like starting in August. We do not have a retirement board meeting in July, so our next one in August, and we're not quite sure what's going to happen between now and then in regards to COVID, shelter in place, and if we're going to be back having our regular meetings in person or not. But one of the sentiments that we all felt was that even if we are able to meet in person, our first priority is everybody's health first. And with that in mind, if we are back to having meetings in person, I know the four of us have all expressed that has to be a more of a personal decision on if based on your personal health and if you feel comfortable coming to meetings in person or not. Of course, that's only four of our opinions. I would like to get feedback from anybody on what your guys' thoughts about what our meetings should look like. Should we leave it open to have Zoom meetings for those people that are not ready to come back, and then we'll still have our in-person meetings, but there'll be some joining by Zoom? Should we just continue doing Zoom, etc.? So just want to get people's feedback. If anybody's has any comments, go ahead and just chime in.
Yeah, I would support that, Andrew.
Okay. Thank you, Eswar. And this would be a fluid thing, of course. We'll reevaluate, through July and see where things are. And we'll definitely be communicating, with everybody on what the options will be. So if no one has really any feedback, there's definitely more time between now and then to provide feedback to myself, Roberto, or anybody else. So was there anybody else had any comments on that?
This is Howard. My only feeling is we may be in a blend for some period of time, and I think probably we'll have to be flexible.
Yeah, and I agree, and that's what we want to do is be flexible. So thank you, Howard. So if not, I want to give a big thanks to staff. You guys did a phenomenal job. Roberto brought it up earlier. There's a lot of work going on behind the scenes to have these Zoom meetings happen and to troubleshoot, especially like today. They did a phenomenal job of muting, the hackers and be able to proceed with the rest of our meeting. So thank you, staff, for all of it that you've done. I also want to thank you, the investment staff. You guys continue to do some phenomenal work. Your presentations are excellent, and just wanted to make sure that you guys know that you're appreciated also. I also want to thank the police department. I mean, they're on the front lines right now going through a lot of stress on their plate, working mandatory right now, and thank you for being on the front lines and supporting everything that's going on and trying to keep the public safe. Just wanted to give you Franco and your department a thank you for that. Is there any other public comments? If not, this meeting is adjourned.
Be safe, everybody.